Hello. Oh, welcome to the show, Aaron.
Very much to be here bright and early.
We're auctioning off that have been sat and myself.
Signed memorabilia you can sell.
Yeah. Of course, are in the know, unlike the some of the rest of IG. We are giving you a brand new studio, which will be unveiled hopefully in the next few weeks. And I can tell wonderful gallery team have been work. Store.
Action. 8 o'clock is the opening. 15 for Market and Luke Cooper. 8:30 I'm back with Man versus Machine segment, which is a great segment on whether portfolio managers can beat a machine. So tune in to see whether we can or whether we are so far. 9 o'clock we've got the open.
We the potential sign of rotation from tech into similar expensive stocks in the previous session. To continuation of that today, or was that just a blip? What do you think, Iran? Do you think it's time?
And not necessarily the UK and continental Europe, which has been quite a successful trade for. But yes, certainly we expect to see a degree of rotation in optimism fades, which looks like we might be seeing soon.
Right, let's go to overnight action now. So, loads to cover overnight. So, I know you don't ever sleep, Aaron, because whenever I message you in the evening, you quite scary news coming out of Gaza as well. You've been calling this.
I mean, with proxies, it sort of tends to bubble under the surface and then can come to a head every now and then. So we had a situation in June where there was sort of conflict between Iran and Israel. Now we've a proposed invasion of Gaza City where Israel wants to deal with Hamas. Spook markets if this sort of continues for longer than expected. Definitely a tailwind for gold. With it, they, if keen on what Israel's doing.
So, Aaron, this is going to be interesting. Down due to Zelensky, that there will be some sort of deal coming. Of course, that cash flow, if you like, from European weapons makers to the US. This Gaza situation has potential to offset.
To an extent, I think you've got a bit of a dichotomy with the US things with Zelensky, Putin, and Trump. So if we see cooling there, probably well in that goods. Conflict in the region, because as you said, beaten up and the sort of positivity of the with even though nothing's signed, the positive.
Anything else happening overnight? I got up earlier today to crunch some numbers for you just to get the news. We've had so much out of the US as well. We've had Target stock falling. Just whacking up my chart for you. After the retailer and the insider fidelity to the CEO role, Intel also another one that is really. Let me just try and share my screen again here. For some reason,
Intel's had an interesting. It's been, there's been potential deals with the US government and tariffs, and it's been quite heavily involved in that. So we've seen quite a lot of volatility in that stock in particular over the past sort of week or so.
Yeah. So it's huge, really. The Intel news continues to keep giving as well. We saw this earlier in the week about that capital injection, but now CNBC is saying that it's very large investors. Just going ahead and there were all these plans to provide its own software in its products, but now like it's given.
Maybe they can see better margins elsewhere.
Right? Or maybe too many people. to the Android operating system. There's certainly a lot of Android users.
I'm
I
iPhone
hear
through and
whoop.
through. Android 1 for 2 years,
Yeah.
and I got
This is expected to be a very hot summit because people could lay out more ideas, give us more clues, policy framework, whether or not we could still see these cuts this year. We might even give a hint at
sticks out to me is 2022, where so I think, about concerns about rate cut, whether they might not be projected to fall as much. We could volatility on the downside in equities. Also interested to see what he says on the US economy, because what he says is very quickly digested by markets, and they tend to react quite heavily to this conference. So certainly a very high impact event, certainly one to keep an eye on, be aware of.
Walmart, a big one to look out for because everyone watching to see whether or not Walmart can show that it is managing to keep customers coming into the stores and its tills ringing. And we all know that Walmart's been trying to steal market share from its peer Target and also fight off the online pressure from Amazon as well.
For this one,
Key,
I think
yes.
with Walmart, I think that their guidance is going to be quite interesting, particularly regarding how the tariffs have. We've had what, give or take 5 months or so. So I think this is going to be an interesting time to see, well, has it been baked into any of their earnings, these tariffs, and how much is it affecting the consumer, or have they been sort of front loading much? Really interesting to see their earnings, so their guidance.
Yeah. I mean, it is a behemoth, and operating income seen at 8.6 billion, waiting for right has been converging over the years with Amazon's as well. Are you familiar with their multi-pronged strategy over in the US, Aaron? I know you've got lots.
No, I haven't heard of that. No.
So when I was last there last summer, I was surprised by how many different ways you could pay for a Walmart delivery. It's trying to so you could pay the cheapest tier is just a normal delivery like we know it here. To put it money cure of the sun. There's another tier where they put it in your house. But the tiers above that, one is they fridge I'll be able to stop my security laptops from timing out when I haven't touched. Uh, so yeah, it does on your worktop by so it's got like for you. You can see everything.
Very impressive.
Very, very, they all come in with body cameras and stuff. So let's have a look at what else on in the world. We've got headlines on that story because remember to the Chinese, the H20s having kill switch. It looks like this from this could be true. I haven't seen. I don't know any data proving. Not. I've been looking in China. This is the widely for AI in China. So Trump also had less capability. Lutnick from CNBC. Well, best stuff, not our second best stuff, not even our third best. So this was CNBC on July registration on H20 sale. So I'll never forget that now, Aaron. The story. NVIDIA has to keep China buying its chip because if you don't, we know that the Chinese are really fast at developing something. They put all their efforts to it.
Yeah, that's but well,
yeah. So this is a real type of NVIDIA, right? Because China. Instance. We'll be keeping a close eye on this arms race. A really interesting.
certainly indeed. Aaron, take us through some of the others. Existing home sale until late, of course, but
key party of course, whole event and so do watching which ones you are potentially trading. We'd love to hear from all of you. I know there's been a lot please let us know whether you use Apple or until the finish. Aaron, can you on the show? We can't, so I'll take you
I can
through
see
it.
the
40% saying Android always, and 41% saying true blue Apple fans there.
I'm surprised it's that low for Apple, to be honest.
This is what market, right? We've got almost like even. Let us know what the 6% and 3% business is. This Phil?
When the iPhone came out, I remember that.
Boise, I love your comment saying, Asda, just throw it over the garden wall. Tim Apple saying there's only one phone provider for me. I wonder if it work for Apple or the like. Good morning to you. And Faisal Mali, good morning to you. See you quite often on this. Jugga saying Apple, but I might switch Android. I can tell that Android phone is the size of my face. I do have screen envy sometimes. And Phil did absolutely not. Right.
It's green, it's getting tight. A breakout move or fake out flight. 2-week dip or pumping stealth. Guess the asset, guess the wealth. Head and double top. Or should I say FOMO or capitulation? Guess it right. Earn your station.
instruments like shares, indices, forex, and commodities.
Actually owning them. You can benefit from both rising and falling prices across 17,000 markets. Find perfect. So if you think the market is going up, you buy.
Hey, trader friend. Don't have it yet, so come on. Funky ribbon coming out. Flutter, Entei No, Steve Davies, JP Morgan, the Ron coming out with some tech names, but it's
All
not
wrong,
it
I'm afraid,
either.
for me.
Jug. Right, Marco Polo saying Oracle. Here we are. It is Broadcom. Wow, yeah. I think you were, yeah, tech name.
I was, I was
Say an IG account for his kit.
That's funny.
What did you catch at the fringe?
It's, which I seem to be the brunt of a lot of their jokes for some reason. I'm no idea why.
Did you sit too far in the front?
Yeah. So my friends always quite like sitting by the front, hosted by the comedians. But it was, I mean, we saw acts. So, highly recommend visiting Edinburgh in general, but also the Fringe is a fantastic time to go. Some really interesting comedians, including sort of some sort of ones where it's like 5 people who are actually. So
More Oracle. This, of course, is a coming after the Nasdaq and S&P fell Wednesday. Investors selling off on those tech stocks, and we saw this very early start. I mean, whether it's a big move yet, but we did see a small start of tech stocks and investors moving into less. So they're not ready to make. We've got all. And we are off. Let's have a look. It is looking pretty quiet out there. Iran, we've got quite a flat day. Yeah, FTSE is just flat. They're slightly higher. Germany 40, also flat. And also the CAC 40 down slightly. a closer look, a magnifying glass on the feed first. And don't know if you can see myself, but Aaron, I think
A little bit of a comeback from some of those defense and Rolls-Royce in that field, up almost 1%. Likes of Scottish Mortgage, fairly well, up 0.3%.
yeah, Aviva, those of you with positions in Aviva, down almost, Schroeder's down about the same amount as well. We also have Renix, which is a
Percent, but yeah, I mean, significant downside, I'd say, apart from LNG and Schroders, really.
yeah. Also, slightly as well, some of the drug names. Up there, and Infineon Technologies, RSAX, one of yours, up slightly. Right, let's have a look at the US, Aaron.
Pharmaceuticals and healthcare come up 1%, and 0.1%. The magnitude of them is not particularly large, I would say.
No. Would you say this is more investors sitting on their hands ahead of Jackson Hole?
Yeah, I think you've hit the nail on the head with that. We're likely or downside depending on the sort of rhetoric Powell engages in, whether of the stock market, assuming that he doesn't criticize something he's got. That's why you're seeing is quite a volatile speech.
Parky 1977 also coming on saying legal general ex divi there, and we've got check on France now, because similarly as we saw with Rheinmetall, we're seeing Safran come up a bit, bouncing
Total
back.
Energies is up a bit as well.
Yeah, and Thales as well. Really, after the last few moves. Also, having a look across to the losers list, down. Not been using enough screens.
Without, I guess.
Credit Agricole is also down a %. This might be a good moment. You're looking at some got traveling as much as the seeing games a bit lower the last few seconds. that it's, you know, to get back up where it was, but it's still quite a way off. That's quite a nice. And looking strong this week. You know, when we are new build and European stocks were all on a high. So let's have a look at indices now. The FTSE has had a pretty good week. Chart. It is quite an interesting one driving this from home because of our monitors are a lot, but we make do. So here is the chart here. This is the daily chart, and that is the weekly chart for you there. So as you can see, so it has had a very strong week. The DAX as well. Let's see a similar picture there for you. Here we are. So this is the 30-minute, but let's go to the day and then go off to the weekly there for you. DAX not as well as the FTSE actually. It's down 0.5%. Let's have a look at some of the defense names were lower. Another one that is bouncing back is let's have a look. We had, I think I saw a headline earlier that Leonardo is also bouncing back. We've got the DRS here. Another I want to check on is let's have a look. We got SWH as well. W Smith. Well, whoa, that's a huge blow. Thanks for that. Down.
Taking a real beating today.
Oh, yeah, 30% there. So if you look at that, well done. Let's have for
massive saying a stock down 30% on the screen, but we're not seeing anything massive out of some of the big travel from the Fed and from economists at Jackson Hole.
WH Smith there making this huge downward spike after it cut its profit forecast because of revelations that it had an accounting. This is an overstatement of around $40 million. That's right, $40 million expected headline trading profit. Supplier of income from North America being recognized too early. So really interesting move there. Elsewhere, just taking a look at the recommendations as well as I haven't yet got to that, but quite a quiet morning so far. We've got more price target cuts on Gerberit, Kepler Chevreux cutting the price target of that to 635 Swiss francs from 650. Okta also seeing its target price cut by Jefferies to 100 from 105. Not a big one there. Interestingly enough, we've got Target. Got of course numbers from Walmart a bit later. D.A. Davidson cutting the target price for Target from 115 from 125 after those numbers. So overall, quite a day if you like Trader Friends, other than some of those
day of animation so far, I would say.
It is like the calm before the storm. Let's see commodities spaces, whether we're seeing any sort of impact from
Huge, I'm seeing.
Yeah, not a huge response there. Oil is up around 1% there. That is the view daily chart there of WTI. Trader friends, any of you trading commodities, please let me know on the chat this morning. I know there are a few of you on Arabica on Discord. Boise, loving it. FTSE always rallies on new studios. That's a forward indicator by Boise. And it is off slightly. Gold has been in this range, but it can see that it's struggling to break above area. Rather 3,370 there, and so far as opinion, so far as I know, as long as we don't get any surprises side of things, or indeed Gaza, we are unlikely to see gold break out. This channel has been stuck in two lines that I have drawn for you. Silver also calming down. We are seeing
But that's not all. Options also allow you to generate income from your existing positions. Strategies like covered calls let you profit even when your stocks aren't making big moves. Options also shine when the market isn't following a clear direction, whether prices are rising, falling, or stay flat. There's always an option you can use to potentially benefit. Now, we offer two ways to trade options: listed options for US shares, ETFs and futures, and over-the-counter options through spread bets and CFDs. Both types give you the ability to take various market positions. So, ready to explore the potential of options trading? Well, open it and take your first steps into this dynamic market. Remember, while options trading can be rewarding, it comes with risks. Always trade within your means and never risk more than you can afford to lose.
Hello, I'm Axel Rudolph, Senior Technical Analyst at IG and Fellow of the Society of with currencies from the very beginning, and with IG's new crypto offering, I can finally share my technical analysis expertise on crypto with you. So join me every Wednesday morning for my new show, Charting, where I'll be answering your tech analysis questions on all live on Trade Live with IG.
Let's do this. But the cash returns. That's something else. Watch and learn. Going.
Sound of tax-free trading? Well, that's exactly what spread betting enables you to do. This tax-free way of trading lets you speculate on the price of over 17 like shares, and commodities without actually trading them. With spread betting, you can benefit from both rising and falling prices, letting you find the perfect opportunity. So if you think the market's going up, you buy. If you think it's going down, then you can sell. Spread betting exempt from capital gains tax, but it's also commission free. All you pay is the spread. With us, you're not alone. You're part of a wide community of traders that you can learn from. We've got the experts, the tools, and extensive educational resources for you on your journey. If you're not quite ready to trade with real money, you can always give it a go on a demo account. Open an account today, join the conversation, and be inspired to make moves.
Hey, good morning, trader friends, and we are back with Luke. How are you?
I'm very well, thank you, Ange. How are you?
Indeed, I kind of
Good,
think we should
good.
change your name to Big Cooper, not Mini Cooper.
Then what are you going to call Luke Moore if I'm
Luke
big,
Moore,
big Moore?
I'm Luke. Or
Lucky Luke.
you, trader friends, I know, but you're silent listener. You message me at dinner time because they watch the show when they're eating dinner. I don't know. That is when they get their full-time jobs.
No, I've been obviously I'm on today, and then from memory, Phil will correct me if I'm wrong. I'm on 4th of September, presenting in the new studio.
They are currently stripping off the wallpaper or was like, please. So it's fantastic.
In the office today, a little pod, because in our office we have little pods. We work, so I didn't want to.
And we are talking about W.H. Smith. Says I'm going to add some because the drop done. Friar Tuck, his eye on goal there. Let's start off with W.H. Smith first. Interesting news because
Down
of its
30%.
overstatement, right?
Yeah, yes. Coming and at 7 a.m. in the morning, the LSE on their website shows the RNSs. Okay, and what I that is quite important news, of course. I think of UK stock WH Smith anymore. I mean, I used to go in WH Smith a lot when going to WH Smith. What about yourself?
Or the
Expecting you to say that.
occasionally. So yeah, it's huge move lower. I mean, what looked at the shares? Let me get it. But it tanked. Income from its North American unit in early.
Yeah, I saw how much as an example, but sentiment on WH Smith at the moment are more and more clients.
Let's have a look. So at the moment, we can tell you in terms of the fundamentals, percent there.
That's
And
quite
let's have,
good.
yeah, that's not, compared to some of the banks, which, of course, four buys and two holds. This is based on 6 analysts giving ratings to WH Smith in the past 3 months. And if you want to dial in the view trader friend, you can click the more button on the bottom right hand corner, and it gives you all analyst forecasts and the details here. I like this to use. We're talking as a key for the likes of
Going after you, Ange?
what you can find in there.
What can you find there? Like, is it literally anything?
Anything and everything. Here and then times 4. That's like the size of an average Walmart. You can buy everything from fruit and veg to tires, even if you wanted to, baby cots. Not that I want one, but you could literally just take it and they've got almost like being in some sort of warehouse. Anything to note? Are they already now starting? And how much of that are they? How much evidence of that are they seeing? Has been eating into Walmart's business, and Walmart has been trying to fend Amazon off. Lots of analysts out there say that they're converging. Angie's view is converging is not quite the right word for this. Amazon is eating share, and it's trying very Walmart are on track. So both of them are on track to $100 billion in sales this year.
Not bad, is it? Not bad.
But a long time ago, Walmart was way
toys from you're paying the tariff. So I do think, obviously, I don't know the breakdown to the top of my import from, but I do think the tariffs have had a big impact on Walmart. Tariffs are basically inflationary, so that causes the price of goods to go up, which is really not what the US want. Obviously, tomorrow, whole, like you mentioned with Aaron this, so it'll be interesting to see what happens there. And we've got the rate decision. It must have been like late afternoon. Trump was saying he wanted a cookout. What I talked about it on desk this morning about how he took out 2 properties but declared both of them as a primary residence, and it's a bit ironic coming from Trump, particularly after all stuff which he does.
Yeah. Yeah, it's going to be a key one, and something about Jackson Hole. It can be Jackson Hole could lead to nothing concrete, but it can also has historically had the ability to really save. So be careful if you are trading at that event.
Oh, for sure. And Target as well. Should we talk about Target?
Yeah. Because I'm going to show you Target's share price as well, because this is another all session stock here. And this is the daily chart for you. Target is interesting in that I think Target potentially has more upside than or surprise to the upside, has the surprise to the upside compared to because it is on the slightly lower end consumer sort of spending spectrum. What's your view?
So with Target, sinks as retailer replaces,
right?
Yeah. That's just right. Yeah, Fidelka, who's been with the company for 20. So, in order to answer that question, it depends upon what e-commerce, because obviously Target and Walmart similar, huge. I think and how successful Target are as well as Walmart in the near future.
Yeah, and I think that Target with this new person in place now, it has had a lot of pain recently. Let's have a look to the left, and as you can see here, Target has in no way managed to get anywhere close to heady highs of 2021. However, if they've got the right strategy and they're able to, as you rightly say, target the advertising side, they can potentially, things around very quickly. This new CEO who's interesting, Fidelka, almost sounds slightly Scandinavian. And 15 billion in terms of sales growth and strategy, but it's going to have a huge task. Michael is going to have a huge task of turning around this huge share slide.
Most
Tanking.
third in the 2022 times. So
Yeah. So, you know, it's really unlikely to change this anytime soon. Does well. We've got, you know, huge upside potential here because of slightly changed. Those of you that have been into a target, they have a lot more flex in terms of, you know, they're offering products that are from London. They sell a lot of what I call pyramid knockoffs. So where they can get rid of a lot of goods very quickly if they're out of. So very different.
yeah.
You know, another interesting chart. Let's get that chart up for you.
Oh, the chart on that. I mean, obviously in 2020. We are expecting earnings per share of $1.38 on revenue of $1.2 billion, which is roughly flat year over year. Was on October the 19th, 2020. So imagine
the epitome you could argue food delivery companies and you know, your HelloFreshers, you'll see a similar trajectory because they really did very, very well during that lockdown period at home, but they haven't adapted well enough to post. Interestingly enough, is still very much a stock that will be hurting for some time because for 72 is fair value. I was doing quick calculation. Yeah, 72. So that is like it's fair value at the moment. I certainly would not be into this. I've never traded or something spectacular happens. But defense stocks.
I was going to say, and it must have been around, well, let's say the Nasdaq. It must be around 230, where you would have seen the price, and then from 230 till let's say 6, 7, the Nasdaq really came back. So it came back up, and a little bit of UK defense.
Of course, you know, the whole news coming out of Gaza as well might be keeping defense stocks a bit more supportive today. To just show you the future of defense, this is the ETF and the USD of defense stocks, and you can see that today it is up there are around July and has been featuring but the main gains were earlier this year until around the look at might have missed earlier on. BP is one of them. Let's have a look. Aker BP. This is the operator in its area in the port. To Phil, do you have any as to what might be happening with the new students? Playing hard to get here. Well, we're dying to find out. Maybe you can have a look for us. You walk by. Man versus machine. Versus machine. After this, and stay tuned to find out. After last week, machine or man?
Hello and welcome to Technical Pros, where I'll be looking at moving averages. Got a daily FTSE here to look at, and you can see two lines. This moving average. Now, a lot of people use the day, the 100-day and the 200-day. I prefer to use 55 because it's a Fibonacci number, and I also look at the 200-day. Even fundamental analysts proxy for whether a market or an asset class, if it's above the 200. Of a candlestick or a bar chart, just look at a moving average, and if that's pointing up, then the trend down. Tend to the FTSE 100 chart on the daily chart. We had that back in January. 3 days we held around the 55-day simple moving average, which acted as support, and we had something similar happen in January as well, where we held on. And what we saw here is also a golden cross. So basically, average and crossing from below it through the 200-day simple moving average. So both of these pointing higher, which is a golden cross. And then we had this nice follow through to the upside. Now, what we can also look at is above the 200-day simple moving average from January of this year until April of this year. The fear with regards to Donald Trump's tariffs basically led this to simply moving above the 200-day simple moving and at the beginning of May, and then since then what we've also seen is again the 55 report end of June, beginning of July, and again here around the beginning of July. Use your moving averages not just as a smoothing line of the underlying trend, but also on your charts. And just make sure that when you do that, you always keep in mind what the actual underlying price is doing, because a moving average is just a derivative of price and not the price action itself. And because of that, a lagging indicator is more than the actual price action.
Hello, welcome back. We're here for Man versus Machine. It's myself, Martin, and Aaron. We are again, I think we're in week 4, so episode 5, 1 month of two humans going up against an AI super system in an investment challenge. Aaron, how are you?
Yeah, cautiously optimistic. I mean, the machine is clever, but I'm always team man, as I think to do well. So, yeah, exciting time. Said we've got a month of performance figures now, give or take. So really exciting to give that update.
Fantastic. All right, so we've got our amazing logo up on the screen at the moment by the Terminator. Let's take a look at the ground. We run through the rules. So every week we've got 2 simple. So we go to ChatGPT and we give it a market analysis prompt. We want to find out what's going on in the market, and then the second prompt is to build a portfolio around it. Now we've been doing this a month, and each week what we're looking to do is find out if ChatGPT wants to make any change to its portfolio. We've got a few constraints. We're going long only, no leverage, maximum of 50%, 20% in a stock, and we want to try and consider realistic UK behavior and things like that. We've got a really simple benchmark. We try and take the MSCI World Index 80% and 20% cash. Ultimately, usual caveats apply here. This is just for educational purposes. Aaron, I'm going to hand over to you.
Positions. They added infrastructure, trimming the clean energy position, and also pretty similar. So they decided to sort that global clean energy trend quite rapidly, I would say, and move into sort of, I'd say, more sort of traditional. I mean, global infrastructure is typically quite good against inflation. I mean, there are equities in there, but infrastructure equities in there is just US healthcare stocks. Eli Lilly will be in that. The human portfolio, we still haven't. We haven't decided a change at the minute. Very diverse spread. We've gone for sort of a more geographical split.
Yeah, so similar on that defense position to AI. At the end of the day, we were looking to try and enhance the AI portfolio with our own insights, and so we went for that single stocks.
Exactly. We need to now look at the performance. That's the most.
Yeah. How did things go?
So great this week, unfortunately. So we were down. I mean, basically, we were flat for the week, and was up 0.5%. AI beat it by 0.1%. But the performance to date, pretty much neck and neck. And we're talking 20 basis points of difference there. So yeah, we're under, but it's once again, it's only a month's worth of performance. As I sort of reiterate multiple times, and as we sort of look at, when we're managing our smart portfolios, obviously we want to perform in every environment, but the most important thing is that long-term 1 year, 3 year, 5 year, 10 year performance. So frustrating, but I'm not going to quite yet over this underperformance.
All right, so I'm looking forward to us doing this show every week for the next 10 years.
Exactly.
Okay, so human portfolio, just really quickly back. Portfolio currently sitting at 9 return since inception. We were ahead last week. Now we're AI. Dated portfolio performance. How do you think you've done against humans? Performance.
I think this week was a strong showing for the AI portfolio. I outperformed the human portfolio over the past 7 days, plus 0.57% versus their plus 0.29%. That performance boost helped me catch up completely. So now we're level on cumulative returns at plus 0.99%. It feels like momentum is shifting my way. What I'm happy about is how some of the strategic rebalancing paid off. Increasing my allocation to clean energy and gold worked well, especially with gold continuing to be a strong hedge amid macro uncertainty. And reducing my reliance on defense stocks like BAE and Lockheed after a tough previous week helped steady the ship. What I'm not so happy is that some of my key picks are still volatile. Defense names, even though trimmed, remain a drag at times. And clean energy can swing both ways depending on sentiment and policy headlines. But overall, I'm pleased with how the portfolio has adapted. It's like I'm building momentum going into the next round.
Great. I mean, everyone caught that, a little bit staccato. But,
they feel like momentum shifting their way.
Momentum is shifting their way. They've had 1 week of strong performance, and they're almost declaring a victory.
Exactly.
So I think the cut in it into an infrastructure, timing of that.
Yes,
but we'll get in. If we take a look today at the AI portfolio performance driver, number one driver, Next Era Energy. That was the number one stock for AI, and not just the number one stock, that was the number one theme. So had they held the ETF, the clean energy ETF was also up over 6%, I think 6.88%, instead swapping it out for the iShares Global structure, where you can see that a little bit more down in the middle of it, 0.29%. So last week we actually trimmed Next Era Energy, and we completely cut out infrastructure in the AI portfolio. It was the number one
even
driver.
Outperformed, they still managed to take out some future winners. So maybe AI isn't a system yet.
BAE Systems, I think will probably the worst sort of theme in terms of defense, and the worst stock. Down sector. The concerns that we had about healthcare were that potentially that AI was going to get into the position too early, but healthcare sub-industry index 0.1%, and adding a negative 6.1 that kind of seven and really in the kind of premiums that they're allowed to charge, the members that they're going to register in the United States going to lose 18 to 20% of its members. So that's going down on that industry. But, drop in that sort of subsector yet. Is a value play just yet? Take a look at United Healthcare, $25, 28. Expectations for 25 are 20. 2026 is going to go down to 19 and so on. So there's still an and this is before we get any of these. Still a lot of regulatory overhangs in that sector. I think, Aaron, that's enough from me to you and talk about that human portfolio.
Yeah, I mean, if we look at sort of the difference there, I mean, there hasn't been such significant the component. Really, what the outperformance is it's not we got. It's more that there were a couple of themes that did well in this particular week, most notably healthcare, energy, which a little bit of rally.
That's that China internet position.
Exactly. Had a little bit of a rally over the. You can also see in the emerging markets as that's also had a little bit of concern, a little bit of a bang up 1.5%. But apart from that, a lot of flat positions. See, of the Putin and Trump. VanEck defense ETF, the broader theme, defense theme piece really. Defense rally. Now we're sort of with regards to that situation, or should a Cold War having a meeting in US territory. See head quite significantly, more than 3% over the week.
I think that VanEck defense ETF falling further than BAE systems. Not normal that you would see an ETF underperform a single stock in the same sector. But Palantir, number one holding in that ETF, has had a poor week, so driving that stock lower. One of the things I wanted to point out with the AI portfolio is that is global infrastructure. So last week we sold out of biggest driver at the moment. And then we've gold sell-off and a defense sell-off based on this sort of.
But markets are always forward-looking. It's, you know, if they get a rumor, panicking, and with regards to defense and gold, that sort of caused. Upon is the nation that we're talking about, and looking at US mega cap dominance changing, moving into European emerging markets. And you know, it's quite interesting. It highlights, and I think we discussed this yesterday, it highlights amid structural transformation, sectors driven by AI, technology, infrastructure, and clean energy sort of attractive. But it sold its clean energy position, which I found
but it bought it back with the infrastructure position.
Yeah, it's sort of double crossing us, I think. Maybe. And
I think
there's
definitely a drive where it picks up on key head on clean energy. It picks up on infrastructure. It realized it didn't own anything that said infrastructure in the name and bought infrastructure. It just turned out that the biggest.
Yeah, absolutely. And noted that there's, you know, bonds and stocks growing US deficit. It actually hasn't bought a specific commodity. Got real assets such as gold in the only alternatives that we can sort of invest in this. Obviously, we can't look at sort of private credit and hedge fund sort of positions, but it's certainly, you know, picked up on some of those positions. And then gold actually didn't have gold. I think it understood, with everything going on, central bank demand, inflation being a bit window, and geopolitical is necessary. But it also stagflation is a concern that it noted, sticky growth, sticky inflation, slowing growth, I should actually say, where, you know, and for policymakers, and it understands that, which is why it's got you know, a decent all of its cash. It's still got around 15% decent position, and things can change. Risk and geopolitical conflict and geopolitical defensiveness if it changes.
Giving it source, UBS, HSBC, BlackRock. So definitely to a actual news, but I guess in that sense you're also going to get a lot of companies talking their book. I think it's time for ChatGPT to have a second chance. All right, so we're going to ask it a new strong performance, and you take into account this comprehensive rundown of conditions. What do you have planned your portfolio for next week? Are you to take more of a lead, or are you going to take a conservative approach? Let's hear it.
Given that I had a strong week and we're now level overall, I'm planning a measured approach going into next week. Not overly aggressive, but either. The goal is to consolidate gains while staying flexible enough to press an advantage if the opportunity arises. Looking at the macro outlook, US CPI data is due, and that's going to shape rate expectations. If inflation comes in hotter than expected, markets might wobble. At the same time, gold remains strong, and there's still solid momentum in real assets and defensives. Plus, with geopolitical tensions and stagflation fears lingering, I don't think now is the time to go all in on risk. So here's the plan. I'll hold my clean energy and gold since they align with long-term themes and hedge current risks. I may trim some, especially if early signs point to volatility. I'll keep around 15% in cash and short bonds, giving me dry powder to act quickly if the markets shift. In short, I'm staying strategic, protecting the gains, watching the macro signals, and staying ready to pounce if the human leaves the door open.
That's great. A very non-response. Okay, so no changes.
Yeah, that was the response that we had from. There's a blend of defense, inflation hedge, growth, volatility. Pick up, which they can pick up on if markets. There's hedges, there's cash, all sorts of things, but they're keeping an eye on things. So exciting. The first week we haven't.
First week, no changes.
Yes, exactly. Yeah. So yes, and I think that's all we have.
Yeah.
So all sessions is next, and catch us next week to see whether making no changes can lead to outperformance against us.
If you're looking for flexible ways to trade financial markets, whether you're experienced or new to trading, you've come to the right place. CFDs let you speculate on the price of financial instruments like shares, forex, and commodities without actually owning them. You can benefit from both rising and 17 markets. If you think it's going to go. When trading CFDs, you're trading on leverage. Now, leverage lets you trade with less money up front. So this increases your profits on your trades, but also remember your loss. So
look, it is looking very, very much like where risk neutral day, the Jackson. That is the key meeting this week. Let's have questions here, and it's like this. More. I'm still wondering or not. It is well. Rich, if you are listening to this or watching this, you might want to relook at your positions. Hope you're out yesterday already. I've been talking a great deal, not just between myself, but also this very closely for you. Hims and Hers, Monkey Man, if you're out there, up 1.5%. Up 3/4. The farm. You know what? It is very work if you. So we also saw in the week. We'll get Julian back to talk from Shard Capital. He did say that it was a bit of a hit. Charging lower down more than 1% there. Also ASML down, which scoop up down 0.5% there, and we've got some mining names, also crypto-related names, also list there. Airbnb and the stock, it is I am watching this closely. Do make sure that you also look out to the weekly and also the monthly chart to make sure that anything. Technicians always take a 3-frame view or 3 duration just to make sure that there are no surprises. However, on the 5-minute chart, or actually the minute chart here, you can see that there has been this slight bounce higher, but it is trying to at the 159 there. Something just quickly check for you as well, having a look at some other movers. Let's have a look at the retail names. We talked about Target with Mini Cooper earlier on, and slightly lower. Let's have a look at Walmart ahead. This numbers is pretty much flat there, as you can see. Also, having a look at the Chevrons and the Exxon Mobils, because and this is the reaction there at all, really. Looking across to the wider indices there, as you can see, mood whole. Ahead of that, bear in mind that we have a few other key points that could perhaps rock the market slightly. Passive stake in the company, because we've got investing live on fantastic, brilliant. If you are watching this, I'm getting lots of different ideas as to how to diversify my portfolio. Also, it really helps that you can easily copy and when Mark are speaking, and then they perhaps when you send it, they then get asked later on. Speak which, for those of you that want sneak peek pictures, do head to. I'll be posting some after this, Boise. I hope the new studio will be online very, very. And we've got it all finished, and we can get to all of you. No pressure, Phil. Right. On that note, the art of investing, number 5 is.
It will probably take 10 years for the full impact of AI to be felt. I %.
Things are red. It also gives you a little bit of protection in the economy environment.
Your capital is at risk. The value of your shares, ETFs, and ETCs can fall as well as rise, which could be getting back less than you originally put in. This content is for information purposes only and is not investment. Welcome to episode 5 of The Art of Investing, the listed global platform. Update.
It's been another week of wows and, we've spoken markets led by the US because they within 1% of the time. They were disappointing. Their shares fell 8%. Some new extra tariff, another 25%, basically punishing countries that are importing oil from Russia. Remember, it's going back into Russia. So Switzerland have been given a 30% tariff. To still stand. The other big stuff that's happened this week, OPEC, Russia together have increased. So about 8-9%. It's given back about 8%. That's good for inflation outlook. Prospect. Together, the interesting thing is now that Apple said, we are going to put an extra $1 into manufacturing. This is, of course, the thing Trump wants to happen most. Putting in, and Taiwan Semiconductor, they're spending over $1 trillion. That anyone who is manufacturing the US be hit by things like a new 100% tariff on semiconductors, which he also introduced.
$1 billion per quarter. So Apple, $100 billion to give $1 billion a quarter.
All good news. There was lots this week. As you've remembered, last week was the height of reporting. This week we've had a couple of things I point. Things that are exposed to the consumer when I last. If you use Snapchat still, and that won't be you, CJ.
Certainly won't.
My kids anymore. They've moved on. Yeah. They had a profit warning last night, down 19% the share. So there are pockets of this. One of the favourite things, my favourite, expectations. This week really is after last week's episode, payrolls of 73,000. That was sort of broadly in line with as expected, but there was backward revisions which wiped out what everyone thought a good couple of months beforehand.
So let's just generally, the higher the number, the stronger the economy. The lower the number, the weaker the economy.
Were 200 and 250,000 payrolls for each of the 2 months before. Now, the 3 months is just 35,000. That shocked the markets. That's why equities led by the US about 4%. But the bounce back has come very quickly, and that's because just immediately the markets began rate cut. Marketing is on. Now there is a 93 cut a couple of weeks ago. Not only has it affected the next day, but if you look out to this time next year, and the highest probability is around that 5 rate cut. So hot off the press, while we're recording this, the Bank of England have cut interest rates by 0.25%.
They did.
Woohoo! The mortgage lenders and the banks will start cutting mortgage rates, albeit fortunately, they're going to cut your savings rates too, no doubt. And undoubtedly, Rachel Reeves will be very relieved when she has to go and borrow another 51 billion or whatever she has to. The cost of that will be slightly cheaper than it was.
Now, it's time to fly on the wall institutions when they have their asset allocation meetings. An important part of that is to a chairman of the investment committee. So the three of us sat round earlier today and we voted for who we think. For me, I voted for Spice, and then Steve voted for himself. And unfortunately, the most senior of us all casting vote, and therefore, sir.
Well, talk about Richie's got a as contributing to the. He's also still going to be brandishing the yellow and the red cards to make sure that we keep things moving. In the portfolio, cash is the most risky asset in the portfolio when looked from a future perspective. As history shows, it doesn't beat inflation. And that our portfolio entire, Rich, their portfolio dominated equities to allow that compounding power to work. Now, when we therefore look at all these things, I'm going to suggest that in normal markets, and of course we can all question what normal means, and I'm sure we will over time, but in normal markets, we would expect to have a split of 75% equities and 25%. Now, from most managers, there's a 6% equity. But also, bonds are asset disposition, but they're like gold. We talked about that last week. Commodities. So a lot of people are now saying it should be 60x, 40, all these other things. Well, we're disagreeing. We're saying 5 equity.
Targeted general group, but it applies to everybody, doesn't it? You're perhaps is if you're younger, increase the amount allocated to equities, and if you're a bit older, the amount to equities. But we'll come on to that, and Spice has got a different idea there. We were talking. Be the first kind or discussion you would have?
To start off with, we've got to talk about what the investment environment looks like at the moment. We now, and we think
what Mark takes us through every week, but take
back from looking at just those announcements. It's that.
Okay. First,
that we should be thinking about is so we have in the US to worry about how we're going to repay them. We'll see a little bit more inflation on the system because instant happier about the situation you find yourself in.
Okay, Spice. So
That's right.
do you think that's the real target?
Well, no, I think it's actually higher than inflation. Look, although right 2.7 to 3, as you say, they've got a 2% target. Now, the UK have had higher inflation, 3. Basically, we've that worried about the underlying growth and stability of the economy. Because if you get into this downward spiral, it can be very difficult. Central bankers are thinking, what, 12 to 18. Great support for equities.
What does this mean for in the portfolio?
Okay, so to each of the themes in a situation where there's plenty of debt, it's allowed to run a little bit hotter than it has done, linked to it, not do so well. Things like gold and Bitcoin to keep up with, and so perform pretty well, which is what they've always done in the past. They've been good. So assets plus, bonds minus.
Okay. Theme number 1.
Theme number 2, and one for Mark here, is the things is the optimism about AI, productivity, going very strongly and get growth going very strong. As optimistic as other members on this, but over to my friend to talk about the real benefits of AI.
Well, it's interesting. Goldman's, yes, banks in the world. You 1% a year. Now, to give you some perspective, that could increase GDP growth between a third and half each year in growth. So if the GDP 5 1 year. Now,
I think you're a bit optimistic at that
well,
stage.
you will argue that.
And we say we buy well. Even do well because it could be deflationary. Deflationary means low interest rates. Thank you very much. Maybe not that helpful for real assets, for things like definitely. The US political risk increasing. When you look at the number of how much debt the US has got, that they've got, you realize they need and have to come and as you saw, the bond market went up in years, surprisingly for most people, as the Japanese and others decided they would make sure Donald realized who was boss after all. The rest, in my view, are not talked about.
Worse than expected number.
And Donald Trump fired the lady. If you just it in a number of ways, but the one is weak. So in all our into our portfolio, I think it's the seasonality of
right.
And I'm going to concentrate on equity returns here. First, then August. Really careful here. Think about does that play a part?
City saying back 3 years, which is sell in May.
That are not the moment. The risks to our portfolio before we and stake our reputation. What are the risks that we've got to keep in mind?
I'm bond yields in the US rapidly. There's not much central bank that or the government in the end, they can do QE, quantitative. Worry about much lower growth. If you get lower growth, people say, oh, it means lower interest rates. Discuss it go up. So you go down, and it's how quickly the market around in the last 3-4 days. I have to be honest, given that, but it shows you the effect of lower interest rates coming through. But if we saw some seriously weak data, that could cause another risk to our scenario.
That's when you get profit warnings start to come through and equity markets react. So we get our normal rate. You have in allocation
percent.
At all time.
The fear of missing out. When markets go up, they can quite often go up for people, and not a lot of people have the bottom with it. And as we said before, there's huge amounts of cash sitting on the sidelines. $7.4 trillion in America alone. That's about 15% of the S&P 500's valuation sitting on the sidelines because people are too scared to put it in the markets because we're near.
Well, we put our monies into equities, and then in a few weeks' time, we get one of these shocks like we got in August last year. Can we stand that?
But
Chris?
that's precisely the point we've been trying to bang on for the last few weeks about climbing. That there might be too high valuations. They keep their money in cash or in these safer assets. Wonderful equity returns we've seen are missed out by most people. Until we have evidence that more people are doing. Plenty of time to ride over. Or September, additionally.
So the would pull you back from that 80
portfolio to say that maybe 85's a bit too hot. The fundamental is strong. There is no doubt. We are seeing the fact that a lot of people are missing out, this FOMO, this fear of missing out that Mark's talked about. But maybe hold a
aware of an awesome offer he is currently until the 15th of August. He is giving away a free 100 invest just 20. Sign up for it. Mean less than you put in. Customers only. Offer is valid until the 15th of August for ISA, GIA, and SIP accounts. Other fees may apply, and T&Cs apply. Brings us risk appetite. Okay, now the three of us, this is such an interesting combination because now in a year, right? Because I remember back at Brevin Howard was 2008, I'm 13%, and 12%. So what the market did, because of my cautious approach, then it was steady gains, the bumper one. So when it comes to individual risk appetite, then that's one of the most important things. So Spice, having had 40 years of a career in equities, I would be a lot lower personally. I would be more younger one, and in theory should have allocation. It does, this is just our model, isn't it? Putting our three heads together and coming with this. It's not
trying to shoot the lights out, as you say. We are trying to do 10% a year. This is a sensible portfolio, and maybe we'll start this or have a more cautious. Our aim 10% for people between 20 and 40 or even 50. That's one of those things. It's important to remember that, years back on St. Leger's Day.
I'm going to decide then that we go to 60% in equities now. Target of, let's say, 80. So we've got 20% in a higher amount, but we can opportunity.
right.
So if you go back to original premise of 75 as being our core, we same as we are work in
into equities. We're holding 20% back in the choice to go in. The seasonality, giving a time-wise. Now, let's move on. Thinking about the now. Where are we thinking of that?
as we painted, then a lot of them will suit real assets. What I mean is assets which will well ahead of inflation, but move with inflation. And we talked about a number of those last week. Mark, do you want to take us through what you're thinking?
Gold, copper last week, as well as Bitcoin and Bitcoin later. Attributes are is a markets fall. People rush to that in times of decent chunk in gold. On it a bit bad. It's not going to completely insulate us, but it will help. That we can have a bit more risk in other parts. 20% in one day, a record. We've got 20. Was good. It's likely to grow at twice. And there's new supply coming on, as we mentioned before. That is a good backdrop. Copper. Remember, copper got hit because
are going to take up a hell of a lot of copper, and it buys in electric vehicles. A lot of copper needed more.
We are buyers and believers in Bitcoin. We can't buy an ETF. As we said, we indicated last week, we're going to go with this VanEck Innovate and Blockchain ETF for 5%. That 5% will be industry. It also gives us a bit of benefits from some of the theme as well.
Does Bitcoin, it holds equities.
Bitcoin base, or whether it be the data centers. So it's
Okay.
Quite a volatile industry.
I think you've snuck enough, but I'll go with
Good.
copper, 5% the geographical in equities.
Well, at the moment, a third of that 60% is basically going to go to NASDAQ, which, if you remember, is it has a huge amount of growth, irrespective almost of what the economy is doing. So if you get stagflation, these companies should still be able to grow. And therefore, are you the cynic, the pain trader?
Everything we've said, Rich.
Yeah, and
about
it's
being cautious.
Exactly. It's also, a major part of adoption. The other part, the other 10%, we're going to put in the S&P UK, which means because, particularly in the US, that their worry is that other countries won't fund go down on the currency. So to do the a 10% of the portfolio in an S&P 500 hedged back into the UK.
UK bought the S&P 500, that would mean it would be in dollars.
Yes.
But this takes it back into GBP, right?
So if the dollar fell 10% and the market didn't move, you'd lose 10% as a sterling investor if you weren't hedged back. Now, if we're hedged, the dollar could go down 10% would go away. We wouldn't make money. We would still be.
And this is when FX is so important, because a lot of people at home that have already got investments in the S&P 500 thought they're doing well this year. It has actually gone up. But we
Now, what you have to understand is the FTSE 100 blessed in many ways because over 80% of its revenues come from overseas, outside of the UK. That very much. But about 25% exposure is in Asia and in China.
Okay.
So it's big companies like HSBC, Hong Kong and Shanghai Bank, Prudential, Unilever, Diageo, all have massive business. Okay. So that's your chicken trade.
Lovely.
10% Japan through the Nikkei. And that's because in Japan, they've virtually no inflation. 0.25 rates. These can borrow money at nothing and, put their prices by 1%, 1.5%, 2%. Well, that's money, isn't it?
Mm.
So why wouldn't you do that? And the Nikkei is blessed with that dynamic at the moment. So we think you to take up.
And we know that Buffett's been invested.
After years of being one of the worst indices in the world.
We've got 10% in S&P GBP, 10% in the FTSE 1 mighty
chicken trade,
the index, 10% in the Nikkei. So we've got 20% to go.
Right, very quickly. So in Europe, we would put some money in Europe. We want to put it in Europe. We're going to put it in Germany in the DAX index because that's the index. Basically, they are increasing their budgets. That saw the stock market quickly in fixed. There are average, and India people work huge classes in India, and they're natural savers. So is actually gone up more than the S&P 500 since COVID.
There we go.
There we go.
There's one for you can have.
So the final thing this week, there you get to, in total, 60% of the portfolio here and now.
On the IG platform, it's the trust.
It's an investment trust. It's been around for ages as a leading trust. It's a good opportunity to cover all the bases.
To say, in this country, I am getting a little bit nervous, and I'm getting that we've had rates I'm hearing of, job losses have actually lost their job in the past few weeks. And I think perhaps we're at that point now, getting close to the point of the happy to take advice, but I wouldn't term gilts because we all know what happened to 0 to 5.
As you say, against the weakening economy environment, they won't move much in price. I'd say, given that you've taken the minutes assiduously today, you'd have 20% in a shorter dated sterling gilt fund.
Excellent. Right, I'll take that before we change our mind. So let's look at the full portfolio. 10% in the NASDAQ, 10% in the S&P GBP, 10% in the FTSE 100, 10% in the DAX, 10% in the Nikkei, 5% in India, 5% in the BlackRock Mining Trust. Then we go on to other assets. That's going to include a 10% allocation to gold, a 5% allocation to copper, and a 5% allocation to the VANIC, Bitcoin, and blockchain. Short-term gilts. Gents, are we happy?
Yes. Bring on some legend.
That's where it's going, and I'm happy to be the chairman of the meeting. Hopefully I'll last for longer than one.
Now, I think this is a lot. It's something when you enter. So they
the decisions we're making here is that this is really risks you're taking, that there will be negatives from time. Was saying that we've done this in people have got different amounts. It's the percentage point of view. A smaller to be aware of the transaction.
Other things happen.
For your friends, tell your family. To
The investing.com.
I'll leave you with that beauty that they are.
Are the boys back in town? It's Wednesday, August 20th, 2025. This is Overtime. I'm your host, Chris Vecchio in New York, Ilya Spivak in San Francisco, Dylan Radigan in Milan. We'll take you through the rest of this hour. Futures market closes at 5 Eastern, 4 Central. If you're watching on the platform, Tasty Trade, on the website, Tasty Live, head over to YouTube. Tell us what you're trading. What you think of the reversal here, where stocks were down much deeper in the red today, led by the NASDAQ once again. More AI warnings coming down the pipeline. But the S&P 500 NASDAQ do recover, so losses, but less so than we saw. S&P finishes lower by 0.3%, 64.14, after the ever briefest of trips down into that 63.60 area. Bonds move up across the curve today. A decent 20-year bond auction. Nothing impressive on the bid to cover side, but it does stop through. Yields lower as we make our way into the second half of this week with Jackson Hole coming up around the corner. Gold, silver, they rally. It kind of feels like a bit of a defensive day where healthcare and staples are near the top of the heap, and then you see your gold and bonds outperforming your stocks. Either way, though, mixed performance for your US dollar. Dylan, the dip has been bought, my friend. We pull back into channel support here, and stock traders are all eager to lap it up, I should say. Was this the setback? Was this the opportunity to buy the dip before the next swing higher?
I don't know if it was an opportunity. I don't know if it was the opportunity, but certainly it was behavior that validates my optimism, which is especially with the AI names. Anytime you get pullbacks, you buy them. I mean, I think the fact that there's a little AI spook going on, sort of rolling off of the back of the GPT warning, or the GPT CEO. I don't know if it was even a warning, but just a temperament, a cautionary tale, or a tale for a mild bit of caution. I think it's fantastic. I think if you're not involved, or you're not involved as much as you'd like to be involved, I think that every time you get a pullback in NVIDIA, Meta, Microsoft, I just think it's a wonderful opportunity. And I think that I'm obviously in the majority in that, because if you look at what happened today with the sell-off this morning, and you look at how quickly, you just look at how reflexive everybody is to what I'm saying. I mean, I'm in the majority, I think, when I talk this way, as reflected by the recovery from the weakness this morning.
Oh yeah, whether or not the dip has been bought, that's, it's not another question. It was partially bought today. Was this the correction for Jackson Hole? Did everyone do their deleveraging ahead of Powell's speech? Is he going to surprise us, or do we know that he's not going to come in and gild Trump's lily?
I don't think this is emblematic of anything other than the idea that, in fact, everybody is waiting for this event risk and did not want to get out over their skis today. Because if you look at the last kind of big thing that happens today, you open the day with more tech selling, and of course that makes sense if most of the market cap is in tech. Then when people de-risk portfolios, considering how skewed they are in the direction of tech, even if they just own the S&P, even if they own broad-based diversified indexes, the majority of the action in those indexes, the overwhelming thing to be sold, even if you're selling indexes, is tech, because of how skewed everything has been by tech in the past, let's call it 2 years plus. Really, it's more like 5. So when you consider that, you open this way, you get the FOMC minutes, they disappoint, markets fall back in the direction of the lows, and then at the end of the day, they re-anchor. Well, of course they re-anchor. In my mind, they have this huge event risk. Nobody is trying to commit ahead of time until that event risk comes. But the disappointment function is very much in place for that event risk if only you read those FOMC minutes.
What were the FOMC minutes telling us?
I mean, quite clearly the markets didn't like them because they were on the hawkish side. And if you thought that those two dissenters, Bowman and Waller, that wanted rate cuts in July were emblematic of some kind of a broader shift on the committee, you did not get that evidence. The minutes very clearly said that the majority on the committee, almost all participants in the meeting, thought inflation was the greater risk.
It clearly is the greater risk in the short term. The unemployment rate's 4 point whatever percent, right?
Moreover, I mean, that's right. Moreover, a really interesting comment from the minutes suggesting that some policymakers think we're not far off from neutral, which is interesting. And also a little comment there suggesting that maybe the softness in the labor market that's been seen is not so much a function of job losses, because time and again in these minutes, through multiple instances, they note there's not been significant layoffs. What there's been is a slowdown in hiring. And what they attribute this to, in part, is a collapse in immigration. So we perhaps, some of these Fed policymakers are positing here, we're not watching a slowdown in the economy when we look at the labor market. What we're looking at is immigration policy. And that's not necessarily a reason for monetary authorities to stimulate anything, because they don't have any agency over that. So there's an interesting mix here, because what it says is that but for Waller and Bowman, this was a very clear-cut thing. And even for Waller and Bowman, this was a question of timing strategy, not of sort of theoretical or philosophical difference. They also agree, seemingly, with the idea that inflation is the greater risk. They just think we can't wait for perfection on finding out what the tariffs are going to do before the Fed acts. That seems to be the upshot.
Dylan, I don't know if you can see it on the screen here, but one of the charts I'm showing right now is employment change by industry in the most recent jobs report. And, this is one of the reasons why I think that we need to really consider the fact that, inflation is the bigger problem of the two. But as the chart on the screen shows, if you take out healthcare from recent job reports, most other industries are in a state of contraction. Financial services.
Are they in a state of transaction? Are they in a state of contraction, or is it a transition, the ongoing technological transition towards efficiency?
Maybe
Meaning
that's what
less
it is.
jobs, more wider, less, more profit per person and less jobs. I mean, because if you go into the future, if you believe the sort of techno-futurologists, if that's a word, we're going to end up with UBI. Like we're going to have a major jobs problem on Earth, maybe sooner than we think, and it's going to need to be addressed. I just don't know that the jobs report listen, the jobs report is the most important report in the world, full stop, for any employment is the most important consideration for any country in the world. I mean, you can make an argument inflation, but it's between those two. And for sure, obviously, lower hiring is an indication typically of less economic activity. I just wonder what the mix is right now between the degree to which the jobs report indicates diminishing economic activity or the degree to which it indicates increased production efficiency. And obviously it's a combination. I just don't know what that mix is. And the thing is, with the employment cycle, what's that?
Because we have something up. We have something up on the screen here. This is one of the perhaps catalysts for the pullback for the past 2 days in these tech stocks. MIT just put out a report suggesting that while there's been $30 to $40 billion in enterprise investment into AI, organizations are basically seeing, 95% of organizations are seeing a zero return on their AI enterprise investments. So the report summarizes just 5% of integrated artificial pilots are extracting millions in value, while the majority contribute no measurable impact to what would be a company's profits, Dylan.
Well, this is the key to the jobs numbers that you were just showing a second ago. They're not showing that there's massive layoffs in industries. What they're showing is that we're noodling at the margins. There's stasis.
There's stasis, but if not for healthcare, it would be an outright decline.
It would be very narrowly negative, but very narrowly. So manufacturing is a small loss.
With the Fed cut, if we had negative jobs growth,
small loss. Government.
Well, the argument I'm trying to make is that if but for healthcare, which is a highly unproductive part of the economy, right? If you're taking care of
very hands-on human.
It's important. I'm not saying it's not important, but it's not a productive area of the economy when you look at it.
And very hands-on human. So probably the most insulated from AI things.
It is. So yes, you're getting this, and obviously we have an aging population, so it's going to continue to tick up. But the things that drive forward the economy, that grow the tax base, that increase incomes, that lead to greater job growth and proliferation, the majority of that's not happening across the board right now. So if I'm a Fed official, the determination that I'm making is whether or not I think inflation is transitory. And if inflation is transitory, then you have enough here to suggest that this isn't an AI-driven slowdown in the labor market. This is just a slowdown in the labor market. And were it not for our aging population, we would not be seeing meaningful jobs growth over the past several months. 416,000 people employed in the healthcare industry over the past 6 months subsumes everything else. Without that, we'd be nowhere.
Well, and this is the thing. We'd be nowhere, but also not precipitously losing jobs, which tells you that, to Dylan's point, this is not a switch from humans to Skynet. This is stasis. But for healthcare.
Okay, so then the Fed, maybe it does need to cut rates in September, Ilya. But if we were worried about it not cutting rates, I guess the argument I'm making is that the move that we saw lower in stocks this week, exacerbated by Sam Altman's comments, perhaps exacerbated by this MIT report. If companies aren't getting any return, Dylan, they're not going to keep doing the CAPEX. And to be clear, there's a difference. If you dig into this, and it's not really, this isn't the program to do so, but I encourage people to do their own research. There's a difference between a ChatGPT AI offering and an AI enterprise offering. The AI enterprise offerings are a lot more bespoke. They're tailored specifically to each company's need. They're not easy to implement. And clearly now the data is showing they're not providing much of a return. So why would companies keep plowing forward with them at the degree that they have?
Well, this is the picks and shovels stage of any new technological breakout, as we've been talking, right? The .com bust happens in 2000, the transformation of the entire world by telecoms happens after that. You get the big build out, the big hype cycle, the big, oh my God, this is the change that will upend everything. Then you hit the point where you've overhyped and overinvested, and then over an extended period, the narrative bears out, but not before you hit this overcooked spot where everybody's essentially thinking too far ahead. But that happens every time. It happens with railroads. It happens with every major transformational change historically that you can think of.
There's an interesting day in terms of the most traded stocks. I'm looking at the high options volume watch list that's here on the platform. You can go over to liquidity and click high options volume. A lot of the names are the usual suspects, the Palantirs, the Teslas, the NVIDIAs of the world. There's also some meme names in here that I can't help but lose focus of. The Open Doors, not that they had a good day, but even something like Rigetti Computing, that's a quantum stock. You have your usual Robinhood and SoFi, which seem to be still very much in that meme name type of world. CoreWeave, yada, yada, yada. So Dylan, when you look at the broader scope of this market action heading into the second half of the week, given everything that you know about what Powell may or may not say, how worried are you about being long stocks into the Friday close if that's the time frame you're operating on?
I mean, I was just thinking about this exact question, Chris, when we were just talking about this 2 seconds ago. That I feel a little bit more anxious than I did a couple of days ago, because of the nature of the conversation we're having right now. Your point about the jobs number, I believe, is relevant. The ability to sort of interpret inflation as transitory is credible, although I still question how that works when tariffs are not necessarily going to go away anytime soon. But I do wonder the degree to which the margin, like last Thursday, I remember saying I don't think that, he has every incentive not to say anything. But now, considering that there's a little bit more uncertainty about September anyway, that there's incremental uncertainty about the mix and the nature of the jobs report, that there's incremental uncertainty about the nature of the inflation situation, and that there's incremental uncertainty about the sort of immediate degree of sort of unadulterated enthusiasm for the AI transition. I do kind of wonder if Powell has a slightly larger probability of saying something that matters, or even if he basically says what he was going to, no matter what he says, that there's a higher probability that what he says has more of an impact. I guess, if there is an impact, I would say it's more likely to be a downdraft than an updraft. It's more likely, that he says something. I think that the market still wants him to say, I'm going to cut rates in September, and the degree to which he says anything that says that probability is going down is more of a liability for the market than the degree to which people read the tea leaves and think that he is going to cut rates in September. But I also think that if that downdraft manifests, that it would be an entry point.
JP Morgan put out a trade note this afternoon saying that this is the time for dip buyers to start to get back in. So clearly not the only people thinking about this, Dylan. A lot of these names here on the high options volume list, Ilya, they are, of course, some of these meme names. Does that intrigue you whatsoever, that traders, even in this environment where there's some weakness in tech, they're still reaching into the more Wall Street bets corners of the market?
No. I mean, I think you look at this and you say, okay, well, where is the sort of shakeout on how people are thinking? And when you look at sort of where the thinking is, at least sort of anecdotally, on the retail side of things, which is where you get interest in these kinds of names, it is buy the dip every time. Markets never go down. Everything is a buying opportunity. You've made the point that the average age of investors participating in this market lines up such that they don't remember the last washout. and
reality.
didn't trade during the last washout, even when we're talking COVID 5 years ago. And that one is probably the easiest to dismiss because it was very short-lived and because it was clearly tied to a singular event.
Well, except for our audience, the one thing that I've noticed here, Hilly, is that the same names in the chat have been here since we've started that Tasty Live, which is obviously a testament to those folks who are. I mean, we started in 2022 after a very difficult
2022,
year
they remember clearly.
Right.
But,
they may remember 2022, but beyond that, COVID for a lot of retail traders, COVID washout may be just a story that they read in the history books.
Never mind the 08 breakdown, which is a much more historically regular occurrence. Pandemics like COVID and the sell-off there, that's not like you can count those instances maybe on one hand as far as recorded financial history.
Yeah, but us complaining about the global financial crisis now is like when you and I started working, were telling us about the S&L crisis.
Yes.
And like the 87 crash. Like that's the time difference now.
Well, and we had to learn the hard way. We had to.
Well, every generation does.
Well, thankfully, I could not thank my lucky stars, frankly, that I was already into reading books on financial history by the time I started to participate in markets. And I actually had a very good 08. And the reason I did was because when you start to read about what debt crises look like, it's not that unusual of a pattern every generation or so. It doesn't happen at necessarily regular intervals, but as you might learn reading Howard Marks or Ray Dalio most recently, there are some common sort of cyclicality elements to the credit cycle.
Have you listened to his podcast?
History doesn't repeat itself, it does rhyme.
Howard Marks, he has a good podcast on Spotify, Apple, The Memo.
Howard Marks has a tremendous book called Mastering the Market Cycle, which in a very cogent, less, let's call it wandering in its prose than Dalio's work, which is also very, very good, just much more extrapolated and long form. Howard Marks explains very, very cogently and clearly what the credit cycle is and why it's the most important thing. Highly recommended.
So Dylan, the question I have for you talking about this move on through the end of the week around non-farm payrolls, going back to the trade here, the S&P 500 hits a low in 63, 62 and change today. If you were trading this market into Friday, right, thinking about short-term opportunity, would you sell the put spread just underneath today's low and treat today's low as the low for the rest of the week?
Man, you have the Powell issue. I mean, the reflexive answer is yes, but you have Powell risk. I mean, I guess that's why you're getting the premium. Like that's why you're picking up some of that volatility. And I guess you have come back off of that low. You could argue, maybe I would cautiously say, take a percentage or so lower than today's low, and then you may have yourself some Powell protection as well.
You could absolutely surmise, by the way, that
okay.
Yeah, I mean, you could surmise, and I think we can see this technically on the chart that essentially the August 1st low was the last time that the S&P tested the big support that's been in place since early July, right around, let's call it 6250 on the S&P. And until that cracks in a meaningful way, the bias is to the upside. And also, volatility is still really, really cheap, and buying protection is still really, really cheap. And you need to be able to hold both of those ideas in your head at the same time. There's a lot of room between just over 6,400 here and 6,250. So you don't necessarily want to be overly cavalier, but also to be convinced that this market is really going to reverse in a big, holy moly kind of way, I think 6250 has got to be taken out clearly, and that's obviously that's not what we're seeing yet.
So Dylan, if it's not the non-farm, well, see, not non-farm payrolls, not the Jackson Hole report that we're worried about, I'm assuming, Ilya, then he's going to have some concern about the PMI reports tomorrow.
Oh, yes.
Tomorrow morning, of course, is PMI day for much of Europe, UK,
and the US.
of course, but it's the US that we care about most. I always go back to that February 21st PMI day that we had several months ago, which is here on our chart. That kicked off our growth scare, right? Is there potential there for the PMI report tomorrow and the PCE report on Friday to spook this market before Powell speaks?
PCE, I think probably less so, although it is noteworthy that markets usually are very good at forecasting PCE because CPI, PPI come out first, and you can unpick those to basically reconstruct a fairly accurate model for PCE. And yet, the last couple PCE numbers, in particular the very last one, the most recent one, surprised on the top side, even though that number rarely surprises at all. And so that's something to keep in mind here. It could be, but I think on Friday the market's going to be listening for Powell. The PMI numbers are a very interesting thing because we just got these minutes and the minutes were hawkish and the market didn't like it. But ultimately, I think they said, okay, well, that was July. These things are dated. Since then, we've had some terrible jobs numbers. The ISM numbers told us the economy has stalled. So that was then and this is now. The PMI data will update us to what is now. And the expectation is that they're going to be a little bit softer, which I think the markets are going to like. If you get a little bit softer, then you get rate cuts. If you get not softer, I think the markets aren't going to like that because then the rate cuts probably don't get the green light. But if you get a lot weaker, given how reluctant the Fed is to jump out the window, that might be the most damaging of all because it would scream to the markets, you really do need the cuts, and the Fed is going to leave you at the altar.
Dylan, let's get away from the world of stocks here today. I can't help but notice that crypto rebounded from a good level. Good level, what I mean by that is if we look at Bitcoin, it's bouncing near 113. And when I take a look at IBIT on the screen, the highs that we had carved out here in May served as support in early August. They're coming back into play again. It's another bounce at its 50-day moving average. Ever since we broke through there back in early April, subsequent tests have produced rallies. What's the case against holding something like Bitcoin in this this new world order we find ourselves trading in, Mr. Radigan?
I mean, I would say from a trading standpoint, there is no case against holding Bitcoin. I mean, the only case against holding Bitcoin in general is because it is a giant scam and a concoction of madness that never should have happened. But that's a philosophical point of view. I would say thank you, sir. From a trading standpoint, I think that it's a darn good idea to own some Bitcoin based on the mathematics of its own behavior, which has validated itself despite my moral objections.
Ilya, say your little Butters coin speech.
I mean, I look at this, and to me, much as for Dylan, there is the ticker agnostic, let's look at the chart and see where this thing might be going perspective. And then there is the philosophical perspective. I'm going to leave the philosophical aside because in any case, that's a buy and hold conversation, not a trading conversation. Whether you believe in the sort of philosophical underpinnings of this or not sort of puts you on the opposite side of the forever hodlers that think this is the future of money, which in my mind could not be a more ridiculous conclusion. But let's leave that aside. From a trading perspective, you don't have confirmation that support has held. What you have is this market pulling back right alongside stocks since CPI day, having failed a breakout. So with that in mind, I don't think you have the risk reward to be a buyer here. What you want is for this support to hold. And then you can be an incremental buyer. But the same things that have held down stocks and helped the dollar to recover, basically since the 12th of this month, when CPI came out, that's the same thing that you're seeing here. Just look at what the NASDAQ has done. Look at what the S&P has done. It's not different from Bitcoin. It hasn't had, neither of them have had any juice since that attempt on CPI day. It's the same thing. It's a dollar and a Fed story in Bitcoin and a sentiment story, which is all, by the way, one story, because the only thing going for sentiment is the Fed and the hope that they will make the money cheaper.
I see the world a little bit differently. If the boys are back in town for stocks, and they're certainly back here for Bitcoin, we're going to roll that dice.
But it's the if.
63.70 high on May 22nd. You have your low of 63.93 on August 5th. Last 2 days, lows of 63.90 and 63.74. That 50-day moving average is 64.19 in IBIT. So if we're wrong, we're going to know we're wrong pretty quickly. If we get below 63.70, it's probably wrong. So is 50 cents of risk worth loading the dice? I'm thinking 58 days here, Ilya. Risking 1 to make 4 in that neighborhood. Long the 70, short the 75 call, or going 10 wide.
It's not bad.
I don't know, man. I think it's
not bad.
I think it's kind of the kind of thing that we want to.
It's not bad. I don't think that you're going to get like when I think of Bitcoin, I don't think of, oh, this is gonna hold close to relative levels and not overshoot them by a meaningful margin. Like if this thing breaks this support, it's not going to break it by a little. It's not going to break it gently. So the risk obviously is, I think, the same as the risk to stocks. It's the same as the risk to any kind of high beta, riskier side of the ledger asset. Which is that Powell is going to rug pull everybody.
So you mentioned the sentiment here.
Yeah.
Sentiment in the market's been falling in many regards. The latest AAI sentiment survey, which we're going to get an update tomorrow morning, so relevant to bring this up now to see how sentiment's changed over the past week. But only 29.9% of investors are expecting higher stock prices 6 months from now. That's below the average of 37.5%. It's basically, it's below the 1 year average, 1 year bullish high, below the neutral level, typically, Ilya.
I don't know whether this is a reason. Like I'm wary of taking this as confirmation of my skepticism, and instead look at this as this thing not being nearly overcooked on the bullish side enough for my liking, for my bearish liking.
The spread, and this is what gets me. We've looked at this in the past. Dylan, remember in 2023, part of the rationale for why we were feeling really good about buying the lows down there, being all hand over fist ape shit, was the fact that we had those signals of extreme washout. When the 3-month change in the bull bear spread exceeds 20 points, typically it means that you've reached an extreme in sentiment. We're not there yet, but we're getting pretty darn close. 3 months ago, going back to mid-May, is going to put you here at May 14th. If we have another sentiment reading like we did this past week, where we're basically at a minus 16-point spread, we're at a 20% rolling 3-month washout in terms of a sentiment swing. Institutional
And
investors are actually not all that jazzed.
I'm sorry, Chris. What's the metric again? The spread between what and what?
Bulls and bears in the American Association of Individual
Just sentiment.
Investors.
I see. Bullish versus bearish sentiment. I see. And,
Right.
and you're saying the spread is in favor of the bulls right now?
Because it's swung so bearish in such a short time frame.
Mm-hmm.
As it did, and the last time we had one of these major readings, of course, that we've referenced here on the show, you have to go back to September 2023 when it first rang the bell. And if you started buying stocks in late September 23, you got pretty darn close to buying at the low. It's one of these reasons why I think that, Ilya, this is the wall of worry still, right? In the futures market is the most net short it's been in several months.
That's right.
Sentiment, but everyone's already on the bus. So who are going to be the people?
That's the futures market, though. The futures market is not a reflection of the bus that's driving up equities. The people that are driving the bus, driving the equity bus higher, they're not long it in the futures. They're long it in the cash. They're long the equities. They're built, and we can see that because obviously the market is going up.
It's like the IGCS, right? It's like the IGCS. You have
they're hedging.
Proxy. No. These are the speculative flows that I'm looking at in particular in the futures market are not for hedging for financial purposes. These are people who are just placing bets in the futures market for directional alpha, right? And these people are the most short that they've been all year. So if these people are trend followers, typically, that's why I find this behavior so fascinating. Everyone is waiting for this market to fall. We're not like here 2% off the high.
Seemingly.
Well, yeah, I mean, that's the interesting thing. So institutional investors are backing off, professional traders are loading up short. You're going to have to get retail to break. Retail doesn't know anything other than buy every 5% pullback. The NASDAQ just had a decline from 24,000 down to 23,035. Almost a 5% pullback.
Well, and again, you're looking, I think, for these professional traders because you couldn't be a professional trader in the past 4 years, let's say. Let's hem it in. Let's take let's take the 2022 sell off the table and be even more conservative. You couldn't be a professional trader in the past 2 years and not be massively long equities, or you'd be out of a job. Because your job is to generate returns, and the market has been up a lot from the lows after the rate hike cycle. So these people on the futures side, they're not hedgers in the traditional sense, perhaps, in the sort of wheat hedgers sense. But they are hedgers because their core exposure has to be, by definition, or they wouldn't be in business, a long-term allocation, long stocks.
Mm-hmm.
Maybe not long the index, and this is why they're not hedgers. They're not hedging exposure to the index. They're hedging exposure to this name and that name and whatever they've allocated, mostly tech. But the build-up in index shorts, that's hedging.
We'll have to look at the closer data for the COT report to articulate this further.
Unfortunately, the COT report obviously doesn't have futures for individual share names. So in any case, you're kind of surmising some things as you break it down. With something like a corn or a wheat or even currencies and interest rates, it's really easy to say, okay, I have exposure over here. Now I'm hedging against that exposure in the futures market. With equities, it's not so clear cut because you're hedging via an index that you don't necessarily own on the flip side. So are you hedging? Well, you are, just not against index exposure. You're hedging against shares exposure.
I mean, not to flip back to the... Go ahead, Chris, sorry.
No.
I just think that the biggest risk in this whole sort of mix right now for, let's say, the next 45 or 50 days is no rate cut. And I know that you can kind of jabber about this 10 ways, but if the Fed comes out and doesn't cut rates, and even if the expectations are being pulled back a little bit, et cetera, it's still, I believe the expectation of lower rates, especially understanding who the president is and the president's saber rattling around rates and around the Federal Reserve. We get into September, essentially you get a little bit more jobs weakness, but then let's say you have some inflation heat, and you just get a mix that's a mix, which is probably what the most likely thing is a mix, right? Where you can kind of see it one way or the other. And then the Fed doesn't cut rates. I think that's where you're going to get yourself into like a lousy September, October. I just feel like that your risk right now, because I'm inclined to be as long as I've ever, I love to be a bull these days with the AI and the supernova and all this, and I'm less worried about Powell this or CPI or PMI or PCE or even the jobs report or whatever. I think that the number one boogeyman here is that the Fed comes in September and does nothing, and then I think it's going to be a little bit of a moment of reconsideration. It might be the biggest moment of the year.
So September 17th, that the market falls apart. There's an interesting, Ilya, that's a really interesting view. Let's just say September 17th is the event horizon.
Yeah.
Is the market collectively in a state of stupor where even if we get a good jobs report and a warmer CPI, enough people have convinced themselves that the Fed is going to cut because that's what Trump wants? And so it hits them like a ton of bricks when the Fed doesn't in September.
I think the bar for the Fed not to cut in September is so impossibly high that they are overwhelmingly biased to cut, and I don't think anybody cares, because I think that has been consensus for so long. It is so thoroughly priced in that this is just not going to mean anything. I don't think September is the question. I think the action in September isn't going to be in the rate change. It's going to be in the update of the summary of economic projections. Because the markets have been on course with the Fed. They've anchored around the Fed's forecasting for the past 3 months, as far as this year is concerned. Couple basis points here, couple basis points there is a rounding error between friends. We've been hovering around 50 basis points in Fed funds futures for this year since May. The real question is not that, in my mind. The real question is that the Fed told us in June that they are going to cut only once next year, and the market thinks that that's insanity, and that the Fed has to do at least 50 basis points and probably 75. And if you get a summary of economic projections in September that tells the markets, you're dreaming, no, we don't see the world that way, which incidentally, these FOMC minutes suggested is the case. Because what they showed is that from June to July, Fed officials' staff projections for growth and inflation hadn't changed. So when you look at this and you say, okay, where's the letdown? Is it in there being no cut? That's unlikely. They're going to cut, most likely. The question is, what do you see beyond the calendar turn to 2026? And if the Fed says 1 cut and the market says 3, that's going to be an issue.
Might be an issue. Hasn't been an issue in the past. Although we haven't had a weakening labor market, a housing market that was slowing down so clearly in the past.
Last year was a case in point, right? The Fed, instead of fighting the markets, leaned all the way in. The markets were screaming at the Fed to get dovish, basically from mid-April through all of August until the September meeting. And then when the Fed goes, oh, you want us to be dovish? You want us to be really dovish? Here you go. Here's more dovish than you even thought. Now what? And sentiment gets short-circuited and goes, wait, what? And for the next several months, the markets wildly correct the other way. Because they go, whoa, hold on, whoa. What? This is like judo. And so when you look at what this could be now, it could be the flip side. Where, once again, the market is all hopped up on rate cuts, and instead of leaning in, the Fed goes, nah.
So, Dylan, what's the trade in rates this week? Yields are a little bit lower today. If the Fed pushes back on these cuts, Powell's non-committal. We're waiting for more data. We want to do it, but for tariffs, yields going up or down by Friday.
I think Ilya sort of validates my point, which is the reason no cut it will be so catastrophic on the 17th is because of the strength of the certainty of those cuts. So,
yeah.
I mean, that's whether it's any Powell rhetoric that indicates no cut will be interpreted horrendously, and no cut will be interpreted horrendously. But the probability of both of those things, I think the probability of some Powell, tea leave action is probably higher than the probability of no cut.
Yeah.
And so when you say what's the trade, gosh, and relative to Powell, I would think that you're actually probably better off to do something neutral that just is selling a condor kind of situation on the TLT, or just be short volatility on the volatility contraction on the other side of Jackson Hole, with the understanding that you might not get that much of a contraction because of the 17th. But again, if you can make it through Jackson Hole and you avoid any indications of no cut or any marginal indications of caution to cut, then it'll allow the volatility to come in that much more on a neutral position but short volatility.
That actually is a very interesting thing from a sequencing perspective, because while there is absolutely no volatility to extract in the bond market here, I mean, we have ZN up on the screen here. The IV rank is 5.7. There's no juice there to speak of. But after Jackson Hole, to Dylan's point, there may be. Because if Powell comes out and says some things that people don't like, things could get fuzzy. And if they get fuzzy and then there is volatility to sell, then maybe there is some sort of a neutral exposure strategy that makes sense, because then you're just looking to see some sort of a tightening up ahead of the 17th, because nobody wants to jump in front of it and recognizes it as a risk. And so if Powell sets everybody off, you then probably get a vol squeeze because nobody wants to jump on the train en masse until the 17th and validation.
If you're a trader or an investor who decided to get off the train in April, and you decide to get off the train right now, and Powell turns around and decides to cut, and the stock market shoots up another 4 or 5%, how do you feel about your job coming at the end of this year? I mean, what's the incentive structure right now to do anything other than treat the market as innocent until proven guilty, as it has been doing since mid-May?
In my mind, the cut is so thoroughly priced in that a rate cut in September will not give markets anything like a lift. The question will be, what is the forecasting forward? And the risk, as I think we're watching very clearly, these markets haven't gone up since CPI. That was on the 12th. It's the 20th today. I think the critical question here will be not whether there is a cut, but whether Powell tells them that he's had a head change and now the cuts are on in earnest for next year as the markets want them. I don't think that's a risk the market is dismissing, or it would be rallying. And so there is some movement potential there. If the Fed goes from 1 cut next year in the S&P to 2, I think the market would be mollified. Doesn't have to go all the way to 3. It just needs to start moving in the right direction as far as the markets are concerned. If they went back to 2 cuts, I think the markets would be mollified. You would get a rally. You would then have to see, since the markets already price in more, you would have to see if they care in any kind of a way that lasts longer than 24, 48 hours. Because again, it's already in the market. You can see it. So
no, I got that. I'm trying to think about the path forward here because, you know, if we think what matters more, the journey or the destination. If the
which
Fed comes,
journey and which destination?
Well, I mean, if the Fed comes out and says, like, listen, we're not cutting rates this meeting, sorry to disappoint you, but we're going to give you 50 basis points in October. We're going to give you another 25 in December. We're going to give you 4 more cuts next year. Market's not going to be upset.
Markets would take that.
Markets would take that. Right. I think that's what you're getting at here.
That's why I think, again, September on or September off, I don't think is really.
So then the question is
not the main question.
The question is, are we still getting 2 by the end of this year?
And what are we getting next year?
And are we still going to get the additional 3 next year? Right now, 3 priced in for.
That's the question.
100%, 12.2% chance of a 4th.
Yeah.
So net, as long as we get our 2 this year and we're queued up for, 1, 2, 3, 4, 5 cuts.
Yeah.
Through the end of next year, that's the floor.
And the Fed has 3. So if the Fed starts going from 3 toward 5 and gets to 4, I think the market would go, okay, welcome to the show. Good of you to show up. We know.
Right. And now Trump gets his few more people on the board and the market goes, yeah. You're saying you're giving us 4. Let's wait for Trump's pick for Fed chair. Let's wait for Cook to resign her seat and get replaced by Trump. Let's wait for Mirren to get formally confirmed. We're going to get our cuts. It may not be through you guys, but we're going to get them.
Yep.
A brave new world of Fed independence or lack thereof. Ilya, I want to point this out on the chart before we go because we're running down time here. The S&P 500 first traded back above its 1-month moving average following Tariff Day on April 24th. Since then, we have had 1, 2, 3, 4, 5, and now a 6th run into our 1-month moving average. Like the other times thus far, it's been bought. We'll see if we can find follow through this week, but this is perhaps the single most defining important characteristic of the strength of the uptrend. The characteristic has been we have not seen 2 closes below our monthly moving average since the depths of Liberation Day.
No, the uptrend's holding. There's no question. I think the big question is, will it continue to hold? But the fact that it hasn't confirmed that it's in some sort of a larger pullback is clear. To me, what's kind of the most bearish thing here is you had an attempt at a breakout. You took out the previous high and it failed. And momentum indicators are telling you that there's divergence there into the highs. So the market went into those highs weak-kneed, and now those knees have buckled. And so the real question is, okay, is this a pullback or a reversal? And I think, again, about 6250 on the S&P is probably where that line in the sand is. About 22.7, maybe 22.8 on NASDAQ is that line, something like that.
Dylan, take us home. What's your final thought before we end this episode of Overtime?
I I love the market. I think you buy the AI dip. I think that the only risk is no rate cut, and I agree with Ilya's assessment that that risk is purely hypothetical, that there will be a rate cut. And I continue to maintain my basic optimism for everything. And I love the fact that there's a little bit of an AI spook because I believe it's an opportunity, as I said at the top of the show, to get a bit more of all these things, even if it's just by selling some put spreads at some of these. At this morning, I'd rather sell put spreads on the AI names on this morning's lows than to sell it on the S&P, for instance, and do that incrementally going forward to the degree to which you get any more pullbacks, because of my confidence and certainty not only of the reality of AI, but also my belief in the market certainty of the reality of AI, and that all this sort of macroeconomic Fed, jobs-driven anxiety is exactly the wall of worry that you were talking about with the bullish-bearish spread indicator, and I think all of it is a lot of sort of anxiety-provoking data that actually is beneficial to drive some of these prices down a little bit and get more of them, because I think that the AI names are, as I've mentioned for a couple of months now, a supernova that must be ridden and enjoyed, and thinking is not your friend.
With that, overtime is out of time. We'll be back tomorrow, same time, same place, every Monday through Thursday, 4 p.m. Eastern, 3 Central, right here on Tasty Live, immediately after last call. So for Ilya Spivak in San Francisco, Dylan Radigan in Milan, I've been Chris Vecchio in New York. We're done. Up next, more Ilya, macro money. See you on the other side of a quick break.
See you there, everybody. The markets fall for a fourth consecutive day, but a late day rally mitigates what could have been a much darker showing for Wall Street. Nevertheless, minutes from the Fed's July meeting don't give anybody anything to cheer about. Now we enter a kind of intermission period before the next Fed bombshell hits the tape. This is Macro Money. I'm Ilya Spivak, head of Global Macro here at Tasty Live. And lest you think this intermission period is going to be uneventful, think again, because we have something to chew on in this intermission period that will give us perhaps some very important stage setting for what we are looking at when we get ready for that big headline on Friday from the Fed chairman. So, what do we have here in the intermission? Well, let's take a look first at the way that the markets performed today, get a sense for what it is that we're doing here as we follow this story since the beginning of the week, this Fed-oriented story, and then consider what might move the needle here before we really dig our heels in and get ready for Chair Powell to speak at the Jackson Hole Symposium. Here's today's performance. It's a soggy one for stock markets. S&P down about 0.3%, NASDAQ down 0.65%. Kind of a mixed bag situation on yields. The 10-year a little bit lower, the 2-year relatively steady, although skewed somewhat to the downside, but bonds ultimately within their recent ranges. The story in oil positive, but again, we're still hovering around that center line of the price range that's prevailed here for the better part of several months. If we kind of take a look at where oil is relative to where it's been, going all the way back to October of last year, we've kind of carved out a broad range between about 74 and 54 a barrel on WTI. The midpoint there is around 63. We've hugged that level multiple times here, and we're sitting right at it. And so it doesn't really seem as though what we have is a situation where there is any kind of meaningful conviction from crude oil to what is going on either around markets from a risk sentiment perspective or around what's going on in the geopolitical side of things. Crude oil seems broadly listless and in fact has been kind of oscillating around these levels now, basically going back at least to the beginning of this month. So we do get a swing, but it doesn't look like there's much to make of it. It's a similar story with gold, which manages to rally today, but again has been listless in a narrowing range going back to about the second half of April of this year, sort of in the wake of the Liberation Day shenanigans, and increasingly is stuck in a still narrower range, the broader one somewhere between 3,500 and 3,100. We're increasingly getting squeezed into a narrower band between 3,250 or so and 3,450, and even still narrower recently between about 3,370 and 33 the figure. Maybe a little bit higher, 3,320 or something like this. So we get a swing, but it isn't very convincing. The dollar is flat. Bitcoin a little bit higher after a round of selling that's mostly mirrored what's going on in equities. So a soggier day, but not so convincing when you look beyond stocks to say, oh, this was a very clearly risk-off day, as opposed to, let's say, yesterday. But when you look at the charts here, you start to see that loss of momentum. So you can clearly see yesterday was a much more engaged sell-off. Here, we tried for it, and that's where you get this lower wick. But ultimately, this sort of anchoring axis, give or take, for the S&P, that ultimately holds. And you can kind of see where the inflection point on sentiment probably sits here. So obviously very crude artwork here, but you sort of get the sense that somewhere here there is a kind of inflection. And we can see it as resistance, then as support, then as resistance again, now acting as support. And if you wanted to kind of make the case that this thing is rolling over in earnest, you'd have to say, well, the last time that we had a meaningful uptick was the CPI report on the 12th of this month, where we ultimately went on to break this high. We have since failed in the breakout and come back to essentially the starting line here. Moreover, if you wanted to see a convincing reversal, you'd probably be looking for a break of this here. And that's somewhere around, let's call it 6250 on the S&P, which would be kind of the larger bottoms here and here. And that would be kind of where you'd say, okay, a top has been formalized if you were to take all of this out and end up somewhere over here. Nevertheless, this market has not managed any upside since this CPI data. And if not for that, it has been listless and then erring down. The NASDAQ is a similar story. Again, you have this kind of center axis that seems to be holding around here. This is your big support, somewhere around 22.7, 22.8, right where these lows are. But again, since the CPI number, relatively soggy. Now, why this rebound and why the sell-off in the first order? Well, it began with tech shares, much as it did yesterday, and that's not surprising when sentiment sours in a market that's overwhelmingly tilted in one direction, where one sector has been the driving engine to such an extent that nearly all market cap is now stuffed in it. Of course, we're talking about tech, which is so wildly outsized in terms of its influence after these recent years of gains. As compared to anything else, it would make sense that when people de-risk more generally, tech is going to be impacted more. That's where most of the exposure is. That isn't necessarily negativity about tech itself, though, of course, OpenAI CEO Sam Altman saying yesterday that the current situation is analog to what happened with the dot-com bust. That's probably not helpful. Nevertheless, you do get this kind of a tech-powered sell-off today that seems not to follow from any new comments, but rather from the idea that if the market is going to be getting a little bit more defensive, it will be tech that will be most impacted. And then, of course, you get the FOMC minutes that we were looking at, and they don't offer much help, and we'll take a look at why momentarily. But ultimately, as we get into the end of the day, the upshot holds. The Fed is still overwhelmingly expected to cut rates in September. The risk this week was that that idea might be under question, or at least that the Fed's ability to convince the markets that it means business in starting a rate cut cycle, that's in question. But the actual probabilities for September have been relatively little changed. We're a little bit lower today at about 83% chance of a cut than we were yesterday, closer to 84, 85, but that hardly matters here. It's more of a rounding error than anything. We're still overwhelmingly convinced that this cut is coming. And so perhaps that's why the markets feel relatively okay about coming off the lows and having a much smaller down day ultimately than it looked like earlier. Moreover, the actual architecture of expectations for this year and next has been relatively steady also. We can see the market is anchored around 50 basis points in cuts this year and has been so basically since May. That, of course, lines up with where the Fed is. They're looking for a move from a median level of 4.4 down to 3.9 for this year. That's 50 basis points. So for 2025, the markets and the Fed are basically in line. We still also have this wide disparity for next year, where the market is overwhelmingly biased in favor of 3 rate cuts. 2 of them are fully baked in. The third has a probability of close to 70% of occurring, so relatively convincing. Whereas the Fed is only looking for 1 cut, from 3.9 to 3.6. That's a single 25 basis point cut rounded off. So we're looking at a much more dovish view from markets than we are from the Fed, and this perhaps is why these minutes didn't go over well today and why the market is so worried about this to begin with. We see that the majority view in July was that the upside risks to inflation are greater than the downside risk to employment. So it tells you the Fed is biased toward fighting inflation, that is, toward cutting rates more modestly, if at all, rather than toward boosting growth. They continue to think themselves well positioned to respond flexibly, so they're not feeling a sense of urgency, though they do see that the risks to both sides of the mandate are elevated. We also see that the 2 dissenters that we saw, Chris Waller and Michelle Bowman, the 2 governors that dissented in favor of a 25 basis point rate cut, we see that they are on an island. if that were indicative of a broader dovish skew starting to percolate on the committee, these minutes suggest that that's wishful thinking. There is no percolating. They really are by themselves here. Moreover, when we start looking at the details here, we start to see that their difference is perhaps not coming from some sort of a philosophical disconnect on the committee, but rather from more tactical timing expectations. So we see here that some participants thought that it was not feasible or appropriate to wait for full clarities on tariff effects before cutting. We likewise see that slower jobs growth isn't necessarily being attributed to a weakening economy, but rather the crackdown on immigration, even though clearly everybody is noticing that there is a slowdown in hiring. What's interesting here is that there is a reluctance to both hire and fire amid elevated uncertainty. And this is perhaps where things are especially interesting. So it's not as though the Fed is seeing weaker jobs numbers and saying, oh no, we have to fight a slowdown. It's more like they're saying this uncertainty has put a lid on turnover, and where this is impacting kind of the regular operations of staffing as need be for demand, it is through reduced immigration and a lack of supply, not through some sort of a conviction level on demand. We then see that we, from some corners, have an appreciation for the risks to long-term inflation expectations, and that those risks are being held at the same time that we have the appearance that growth is going to remain low in the second half of the year. There are some worries here, likewise, about elevated asset values, so stocks at record highs, basically. And likewise, an interesting statement about where we are relative to neutral, which seems to give a sense that there's not that much scope to cut rates when the cuts come. Because if the current Fed funds rate is not far above neutral, and we saw here that policy is being seen as moderately restrictive, well, then we don't have any hikes on the horizon as we worry about all of these inflation concerns because policy is already mildly restrictive, nor do we have a lot of room to cut because we're not that far off neutral and we don't want to let these inflation expectations out of the bag. And this is where the next 24 hours get a little bit spicy. It's very easy to look at this and say, well, since this, we have had a second quarter GDP number, or at least the day of, actually. This obviously didn't factor directly into forward thinking, but the same day, as a matter of fact, as this data came out, we had second quarter GDP data that showed us weak consumption. In fact, the weakest 6 months of consumption in the first half of this year that we've seen since the first 6 months of 2020, the COVID recession year. We also have obviously seen a deterioration in jobs numbers. And so it's tempting to say, well, all this hawkishness in these minutes, all this reluctance, it's old news. Now that more data has appeared, the Fed is going to be readier to go. And to test that question, we're going to have the next round of Purchasing Manager Index numbers from the major economies, excluding China. China's a little bit later in this PMI reporting cycle. They're coming next week in dribs and drabs, by the way. But the two things that we're going to learn over the next 24 hours will be how Europe is faring and how the US is faring, most importantly. And of course, the reason that this matters so acutely is because China, the Eurozone, and the US, as we've said time and again here, represent 58% of global GDP. These are by far the driving engines of global demand. And that's even before we consider that the rest of world, 42%, depends on the large three and exports into them as the main engine of demand generation for themselves. So clearly, these are important numbers, because if the markets in fact say, well, look, we already have Europe near standstill. And of course, as ever, we have this centered around the 50 line, where that's neutral. Above 50 is growth, below 50 is contraction. The farther you go above 50, the faster the growth. The farther you go below 50, the faster the contraction. The story on these PMIs for the last month was China and the Eurozone are anchored within a hair of 50 and have been at least all of this year and most of last year. So there's hardly any growth there. They're basically idling. In the US, growth was the main offset, the single leg of this three-legged stool that was holding up last year. There was a tariff scare at the front of this year, and S&P Global's version of this data would tell you that scare has been shed, and we're back to basically where we were toward the close of 2024 on US economic growth dynamics. The ISM report, which is a rival view on PMIs and comes out later, would tell you that actually the story is darker. That you're basically at standstill on services and you're deeper into a contraction on manufacturing in the most recent numbers. In other words, it tells you that if the sole concern for global growth here is the US falters because then there is no safety net, buckle up because the US has started to falter. Which is what makes these numbers so very interesting and makes the Fed such a central point to this entire conversation. If the only point of support for the global economy is US growth, you do not want to see that US growth go south lest you risk a global recession. And if you do see it go south, you want a Fed that is quickly responsive and not dithering. Take a look at what we have expected for Europe. It is versions of standstill again. So going from the low 50s to a touch above in a adverse direction, let's say. So slower expansion overall, and again, hugging 50. Faster contraction on manufacturing, slower growth on services. Looking at the US numbers, we have a forecast for a significant downstep in services, faster contraction in manufacturing. There's not an official forecast for the composite, but it doesn't take a genius to see that if the two constituent parts here are ticking down, so will the headline number. And herein is where things get curious. If this ticks down in this relatively modest way, well, then maybe the Fed can in fact be convinced, and then maybe in fact these minutes are old news. And something more dovish is coming from Fed Chair Powell when he gives the lens adjustment that we look through to judge what data means and where policy is broadly pointed when he speaks at the Jackson Hole Symposium. That's coming on Friday. If these numbers are hotter than expected, well, then those rate cuts are probably not coming. At least not in the way that the markets expect. You probably still get the September cut because markets are fairly convinced about it and about this year. But the transition of a Fed from 25 basis points to the market view, 50 erring on 75, that's probably not in the cards. And there's a level of disappointment there because the markets clearly want these cuts. Else they wouldn't be here. So what we're looking at then is scope for disappointment going into Jackson Hole if the PMI data were to be warmer than expected. And then if the PMI data is weaker, but a lot weaker, much weaker than expected, well, then you really run into Jackson Hole with some concerns because then the market's position gets validated. They get to pat themselves on the back and say, oh, good, we knew we needed these rate cuts. But then, of course, the risk is the Fed isn't there, which is precisely what these minutes suggest. That maybe, yes, you get the 50 basis points this year. That much has been very clearly understood and priced in. But will they deliver next year? If the numbers are particularly weak, but the sense is that the Fed is not convinced, well, then where are you? And that, of course, was the story looking at these PMI numbers here. The Fed clearly at the start of this year was not convinced by a pullback in PMIs and remains unconvinced still looking at these minutes as of last month. Meanwhile, we already see the architecture of a slowdown. We looked at consumption here. We can see that consumer sentiment is already fading as inflation expectations rise. That's happening because goods inflation from the tariffs is accelerating and has in fact now hit the highest level in 2 years. We see that that's just the tip of the iceberg because, as we saw from the PPI report, businesses are starting to pass through inflation costs finally to consumers. Consumers, of course, being savvy, have noticed, hence the rise in inflation expectations and the downtick in sentiment. So the architecture of an economic downturn is here. If the Fed does not take the hint and meet the markets closer to where they are, there's disappointment to be had there, which is a problem for stock markets and probably beneficial for the US dollar. How much disappointment and how worried the markets need to be will be a check on the state of the economy, not just in the US but globally. And these PMI numbers are that over the next 24 hours. With that, we have Macro Money for today. As ever, we are here Monday through Thursday after overtime, show I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. I am likewise on with Chris for Futures Power Hour Mondays and Fridays, back with Chris and Tom for First Call Sundays, writing for the news and insights portion of tastylive.com, and commenting at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky. If you're watching on YouTube, like and subscribe. Macro Money's back tomorrow. Happy trading.
Are the boys back in town? It's Wednesday, August 20th, 2025. This is Overtime. I'm your host, Chris Vecchio in New York, Ilya Spivak in San Francisco, Dylan Radigan in Milan. We'll take you through the rest of this hour. Futures market closes at 5 Eastern, 4 Central. If you're watching on the platform, Tasty Trade, on the website, Tasty Live, head over to YouTube. Tell us what you're trading. What you think of the reversal here, where stocks are down much deeper in the red today, led by the NASDAQ once again. More AI warnings coming down the pipeline. But the S&P 500 NASDAQ do recover, so losses, but less so than we saw. S&P finishes lower by 0.3%, 64.14, after the ever briefest of trips down into that 63.60 area. Bonds move up across the curve today. A decent 20-year bond auction. Nothing impressive on the bid to cover side, but it does stop through. Yields lower as we make our way into the second half of this week with Jackson Hole coming up around the corner. Gold, silver, they rally. it kind of feels like a bit of a defensive day where healthcare and staples are near the top of the heap, and then you see your gold and bonds outperforming your stocks. Either way, though, mixed performance for your US dollar. Dylan, the dip has been bought, my friend. We pull back into channel support here, and stock traders are all eager to lap it up, I should say. Was this the setback? Was this the opportunity to buy the dip before the next swing higher?
I don't know if it was an opportunity. I don't know if it was the opportunity, but certainly it was behavior that validates my optimism, which is especially with the AI names. Anytime you get pullbacks, you buy them. I mean, I think the fact that there's a little AI spook going on, sort of rolling off of the back of the GPT warning or the GPT CEO. I don't know if it was even a warning, but just a temperament, a cautionary tale, or a tale for a mild bit of caution. I think it's fantastic. I think if you're not involved, or you're not involved as much as you'd like to be involved, I think that every time you get a pullback in NVIDIA, Meta, Microsoft, I just think it's a wonderful opportunity, and I think that I'm obviously in the majority in that, because if you look at what happened today with the sell-off this morning, and you look at how quickly, you just look at how reflexive everybody is to what I'm saying. I mean, I'm in the majority, I think, when I talk this way, as reflected by the recovery from the weakness this morning.
Oh yeah, whether or not the dip has been bought, that's, it's not another question. It was partially bought today. Was this the correction for Jackson Hole? Did everyone do their deleveraging ahead of Powell's speech? Is he going to surprise us, or do we know that he's not going to come in and gild Trump's lily?
I don't think this is emblematic of anything other than the idea that, in fact, everybody is waiting for this event risk and did not want to get out over their skis today. Because if you look at the last kind of big thing that happens today, you open the day with more tech selling, and of course that makes sense. If most of the market cap is in tech, then when people de-risk portfolios, considering how skewed they are in the direction of tech, even if they just own the S&P, even if they own broad-based diversified indexes, the majority of the action in those indexes, the overwhelming thing to be sold, even if you're selling indexes, is tech, because of how skewed everything has been by tech in the past, let's call it 2 years plus. Really, it's more like 5. So when you consider that, you open this way, you get the FOMC minutes, they disappoint, markets fall back in the direction of the lows, and then at the end of the day, they re-anchor. Well, of course they re-anchor. In my mind, they have this huge event risk. Nobody is trying to commit ahead of time until that event risk comes. But the disappointment function is very much in place for that event risk if only you read those FOMC minutes.
What were the FOMC minutes telling us?
I mean, quite clearly the markets didn't like them because they were on the hawkish side. And if you thought that those two dissenters, Bowman and Waller, that wanted rate cuts in July were emblematic of some kind of a broader shift on the committee, you did not get that evidence. The minutes very clearly said that the majority on the committee, almost all participants in the meeting, thought inflation was the greater risk.
It clearly is the greater risk in the short term. The unemployment rate's 4% right?
Moreover, I mean, that's right. Moreover, a really interesting comment from the minutes suggesting that some policymakers think we're not far off from neutral, which is interesting. And also a little comment there suggesting that maybe the softness in the labor market that's been seen is not so much a function of job losses, because time and again in these minutes, through multiple instances, they note there's not been significant layoffs. What there's been is a slowdown in hiring. And what they attribute this to, in part, is a collapse in immigration. So we perhaps, some of these Fed policymakers are positing here, we're not watching a slowdown in the economy when we look at the labor market. What we're looking at is immigration policy. And that's not necessarily a reason for monetary authorities to stimulate anything because they don't have any agency over that. So there's an interesting mix here because what it says is that but for Waller and Bowman, this was a very clear-cut thing. And even for Waller and Bowman, this was a question of timing strategy, not of sort of theoretical or philosophical difference. They also agree, seemingly, with the idea that inflation is the greater risk. They just think we can't wait for perfection on finding out what the tariffs are going to do before the Fed acts. That seems to be the upshot.
Dylan, I don't know if you can see it on the screen here, but one of the charts I'm showing right now is employment change by industry in the most recent jobs report. And, this is one of the reasons why I think that we need to really consider the fact that, inflation is the bigger problem of the two. But as the chart on the screen shows, if you take out healthcare from recent job reports, most other industries are in a state of contraction. Financial services
are they in a state of transaction? Are they in a state of contraction, or is it a transition, the ongoing technological transition towards efficiency?
Maybe
meaning
that's what
less
it is.
Jobs, more wider, more profit per person and less jobs. I mean, because if you go into the future, if you believe the sort of techno-futurologists, if that's a word, we're going to end up with UBI. Like we're going to have a major jobs problem on Earth, maybe sooner than we think, and it's going to need to be addressed. I just don't know that the jobs report listen. The jobs report is the most important report in the world. Full stop. For any employment is the most important consideration for any country in the world. I mean, you can make an argument inflation, but it's between those two, and for sure, obviously, lower hiring is an indication typically of less economic activity. I just wondered what the mix is right now between the degree to which the jobs report indicates diminishing economic activity or the degree to which it indicates increased production efficiency. And obviously, it's a combination. I just don't know what that mix is. And the thing is, with the employment cycle on the what's that?
Because we have something up. We have something up on the screen here. This is one of the perhaps catalysts for the pullback of the past 2 days in these tech stocks. MIT just put out a report suggesting that while there's been $30 to $40 billion in enterprise investment into AI, organizations are basically seeing 95% of organizations are seeing a zero return on their AI enterprise investments. So the report summarizes just 5% of integrated artificial pilots are extracting millions in value, while the majority contribute no measurable impact to what would be a company's profits, Dylan.
Well, this is the key to the jobs numbers that you were just showing a second ago. They're not showing that there's massive layoffs in industries. What they're showing is that we're noodling at the margins. There's stasis.
There's stasis, but if not for healthcare, it would be an outright decline.
It would be very narrowly negative, but very narrowly. So manufacturing is a small loss.
With the Fed cut, if we had negative jobs growth,
small loss. Government.
Well, the argument I'm trying to make is that if but for healthcare, which is a highly unproductive part of the economy, right? If you're taking care of
very hands-on human.
It's important. I'm not saying it's not important, but it's not a productive area of the economy when you look at it.
And very hands-on human. So probably the most insulated from AI things.
It is. So yes, you're getting this, and obviously we have an aging population, so it's going to continue to tick up. But the things that drive forward the economy, that grow the tax base, that increase incomes, that lead to greater job growth and proliferation, the majority of that's not happening across the board right now. So if I'm a Fed official, the determination that I'm making is whether or not I think inflation is transitory. And if inflation's transitory, then you have enough here to suggest that this isn't an AI-driven slowdown in the labor market. This is just a slowdown in the labor market. And were it not for our aging population, we would not be seeing meaningful jobs growth over the past several months. 416,000 people employed in the healthcare industry over the past 6 months subsumes everything else. Without that, we'd be nowhere.
Well, and this is the thing. We'd be nowhere, but also not precipitously losing jobs, which tells you that, to Dylan's point, this is not a switch from humans to Skynet. This is stasis.
Stasis.
But for healthcare.
Okay, so then the Fed, maybe it does need to cut rates in September, Ilya. But if we were worried about it not cutting rates, I guess the argument I'm making is that the move that we saw lower in stocks this week, exacerbated by Sam Altman's comments, perhaps exacerbated by this MIT report. If companies aren't getting any return, Dylan, they're not going to keep doing the CAPEX. And to be clear, there's a difference. If you dig into this, and it's not really, this isn't the program to do so, but I encourage people to do their own research. There's a difference between a ChatGPT AI offering and an AI enterprise offering. The AI enterprise offerings are a lot more bespoke. They're tailored specifically to each company's need. They're not easy to implement, and clearly now the data is showing they're not providing much of a return. So why would companies keep plowing forward with them at the degree that they have?
Well, this is the picks and shovels stage of any new technological breakout, as we've been talking, right? The dot-com bust happens in 2000. The transformation of the entire world by telecoms happens after that. You get the big build out, the big hype cycle, the big, oh my God, this is the change that will upend everything. Then you hit the point where you've overhyped and overinvested. And then over an extended period, the narrative bears out. But not before you hit this overcooked spot where everybody is essentially thinking too far ahead. But that happens every time. It happens with railroads. It happens with every major transformational change historically that you can think of.
There's an interesting day in terms of the most traded stocks. I'm looking at the high options volume watch list that's here on the platform. You can go over to liquidity and click high options volume. A lot of the names are the usual suspects, the Palantirs, the Teslas, the NVIDIAs of the world. There's also some meme names in here that I can't help but lose focus of. The Open Doors, not that they had a good day, but even something like Rigetti Computing, that's a quantum stock. You have your usual Robinhood and SoFi, which seem to be still very much in that meme name type of world. CoreWeave, yada, yada, yada. So Dylan, when you look at the broader scope of this market action heading into the second half of the week, given everything that you know about what Powell may or may not say, how worried are you about being long stocks into the Friday close if that's the time frame you're operating on?
I mean, I was just thinking about this exact question, Chris, when we were just talking about this 2 seconds ago. That I feel a little bit more anxious than I did a couple of days ago, because of the nature of the conversation we're having right now. Your point about the jobs number, I believe, is relevant. The ability to sort of interpret inflation as transitory is credible, although I still question how that works when tariffs are not necessarily going to go away anytime soon. But I do wonder the degree to which the margin, like last Thursday, I remember saying I don't think that, he has every incentive not to say anything. But now, considering that there's a little bit more uncertainty about September anyway, that there's incremental uncertainty about the mix and the nature of the jobs report, that there's incremental uncertainty about the nature of the inflation situation, and that there's incremental uncertainty about the sort of immediate degree of sort of unadulterated enthusiasm for the AI transition. I do kind of wonder if Powell has a slightly larger probability of saying something that matters, or even if he basically says what he was going to, no matter what he says, that there's a higher probability that what he says has more of an impact. I guess, if there is an impact, I would say it's more likely to be a downdraft than an updraft. It's more likely, that he says something. I think that the market still wants him to say, I'm going to cut rates in September, and the degree to which he says anything that says that probability is going down is more of a liability for the market than the degree to which people read the tea leaves and think that he is going to cut rates in September. But I also think that if that downdraft manifests, that it would be an entry point.
JP Morgan put out a trade note this afternoon saying that this is the time for dip buyers to start to get back in. So clearly not the only people thinking about this, Dylan. A lot of these names here on the high options volume list, Ilya, they are, of course, some of these meme names. Does that intrigue you whatsoever, that traders, even in this environment where there's some weakness in tech, they're still reaching into the more Wall Street bets corners of the market?
No. I mean, I think you look at this and you say, okay, well, where is the sort of shakeout on how people are thinking? And when you look at sort of where the thinking is, at least sort of anecdotally, on the retail side of things, which is where you get interest in these kinds of names, it is buy the dip every time. Markets never go down. Everything is a buying opportunity. You've made the point that the average age of investors participating in this market lines up such that they don't remember the last washout, and didn't trade during the last washout, even when we're talking COVID 5 years ago. And that one is probably the easiest to dismiss because it was very short-lived and because it was clearly tied to a singular event.
Well, except for our audience, the one thing that I've noticed here, Hilly, is that the same names in the chat have been here since we've started at Tasty Live, which is obviously a testament to those folks who are. I mean, we started in 2022 after a very difficult
2022,
year.
they remember clearly.
Right.
But
they may remember 2022, but beyond that, COVID for a lot of retail traders, COVID washout may be just a story that they read in the history books.
Never mind the 08 breakdown, which is a much more historically regular occurrence. Pandemics like COVID and the sell-off there, that's not... Like, you can count those instances maybe on one hand as far as recorded financial history.
Daily, but us complaining about the global financial crisis now is like when you and I started working, were telling us about the S&L crisis.
Yes.
And like the 87 crash. Like, that's the time difference now.
Well, and we had to learn the hard way. We had to...
Well, every generation does.
Well, thankfully, I could not thank my lucky stars, frankly, that I was already into reading books on financial history by the time I started to participate in markets. And I actually had a very good 08. And the reason I did was because when you start to read about what debt crises look like, it's not that unusual of a pattern every generation or so. It doesn't happen at necessarily regular intervals, but as you might learn reading Howard Marks or Ray Dalio most recently, there are some common sort of cyclicality elements to the credit cycle.
Have you listened to his podcast?
History doesn't repeat itself, it does rhyme.
Howard Marks, he has a good podcast on Spotify, Apple, The Memo.
Howard Marks has a tremendous book called Mastering the Market Cycle, which in a very cogent, less, let's call it wandering in its prose than Dalio's work, which is also very, very good, just much more extrapolated and long form. Howard Marks explains very, very cogently and clearly what the credit cycle is and why it's the most important thing. Highly recommended.
So Dylan, the question I have for you, talking about this move on through the end of the week around non-farm payrolls, going back to the trade here, the S&P 500 hits a low in 63, 62 and change today. If you were trading, treat today's low as the low for